Trade volatility, day trading techniques. Minus 1.400.70. Anthony Jones. Trade volatility, day trading techniques. Copyright 2024 Anthony Jones. All rights reserved. Dedication purpose. This book is a combination of valuable lessons and notes that I have learned over time from my experiences in trading these volatile markets. Knowledge is powerful and will help as great assistance in trading today's markets. In this book, I go into details of important trading lessons from winning and losing trades. These are notes that I have recorded and put together as a guide to information shared from past mistakes that have made me into the better trader. I do not want other traders to make the same mistakes from not having proper risk management skills and not being disciplined and patient. This book will help guide your mindset to a more prosperous, successful mind state of awareness for technical analysis, candlestick recognition, intraday setups, fundamental and technical analysis, trending market strategies, and risk management for stocks, crypto, options, or futures, trading to produce and maintain better results. Contents. Introduction. 1. Mindset tips. Good trader. 2. Characteristics. 3. Market structure. 4. Have a trade plan. 5. Set and follow rules. 6. Psychological mindset. 7. Risk management. 8. Analyzing trades. 9. Patience is key. 10. Self-awareness trading technique. 11. Strategy. 12. Law of propensity. 13. Definitions. PG. 2XIV. XXX, XIV, IXE, IXV, LXX, DIR, XX, DR, XCIV. Introduction. With today's unreliable economy, from soaring inflation, cost of living, food, and gas prices fluctuating, you have to have more than one source of income to survive. If your income is less than 6 figures a year, but everyone's debt-to-income ratio is completely different, that is one reason that trading equities are one of the advantageous skills that you can develop. It is the skill of learning how to compound a percent of your income to maximize your profits over time, and sometimes within a short period of time. The skills of knowing how to navigate the market is a skill that no one can take from you. And no matter what circumstances, you will always have a way to grow your money with the correct information, discipline, and mindset. Day trading can make you wealthy and can also make you broke if you allow it to. Losing trades can and will make you unconsciously do unpredictable things depending on your mindset at the time. I have a motivational, determined attitude for success. Therefore, I remain consistent and I never gave up. This can be both positive in trading, or it could also make out for bad decisions at times. Throughout my trading journey, I have lost large amounts of money, and what makes it even worse, it was not from gains in the market, but from actually life savings from working hard. This also will have caused me to revenge trade, which was my biggest mistake. As I look back, the lessons were valuable, but at times I wish if only I could have read a book like this and actually applied the knowledge to my trading. It would have saved me a lot of money as well as mental stress. I went through a lot mentally, but in the end, it has made me a better trader. Everything happens for a reason. And I was blessed enough to be able to bounce back and recover from big losses, even when it felt like I was at rock bottom, considering my monthly bills as well as the debt that I had gotten myself into. Some of the rules and strategies that I put together in this book can also be found anywhere, but they only work if you actually apply them. It's one thing to say you will change habits and do something, and another to actually do it. Successful trading mostly boils down to your psychology and technical analysis combined to obtain and maintain better results. Plan your trade, define your risk, stick to plan. Stock market investing is synonymous with attractive and quick gains and capital appreciation. However, the returns offered by the stock market come with risks attached. You cannot get good returns without undertaking the volatility risks associated with stock price movements. Stock prices are subject to fluctuations, and these are a part and parcel of the stock market. While the price might increase attractively in a bullish market, the same may plummet the next day. So, while you are earning returns one moment, you might incur losses in the next moment as the value of your stock holding falls. So what should you do? Should you not invest in the stock market altogether? Though the stock market is a risky avenue, there are ways in which you can avoid losses. You don't have to abstain from stock trading or stock investing. You just need to be a little wise when it comes to investing in the stock market. Here are some tips which, when followed, would allow you to avoid making considerable losses in the stock market. 1. Mindset tips to avoid losses in the stock market. Learn about the market. Knowledge is power. One of the many reasons why many investors suffer losses in the stock market is because they start their investments with limited or no knowledge. The stock market is a trading marketplace, and unless you know the ins and outs of the domain, you will incur losses. A little knowledge is a dangerous thing, isn't it? Equip yourself with the knowledge of how the market works. Learn the pricing techniques of stocks so that you can anticipate which stock would make a profit and which might suffer a loss. Also, the stock market and the economy of the country are interlinked. If one moves up, the other will follow. Even if the stock market falls, if the economy is strong, the market would rise so that you can remain invested. When you approach stock investing with complete knowledge, you can avoid making rookie mistakes that incur losses. Learn about the stock market and then jump on the investor bandwagon. Research the stock you pick. Do you follow the herd mentality when investing? If you do, it's time you give up the habit. Don't pick stocks only because they are popular with other investors. Research the stock before investing in it. Find out the company's financial position, fundamentals, projected cash flows, market capitalization, market sentiments around the stock, and prospects. If the company is poised to grow and has strong fundamentals, its stock would not give you losses. When investing, either pick already established companies to avoid a possible downturn or those you have researched into. You can take the help of your broker to do your research, but always make an informed choice. Have a long-term perspective. While it is true that stock investing has the potential of quick returns, you should invest with a long-term perspective. There is no quick fix formula for returns in stock investing. You can ride on the market wave and make quick bucks when the market is rising, but always think long-term for stable returns. Long-term investing reduces the risk associated with stock trading. Moreover, even after a crash, the stock market always rebounds and gives positive growth. You just need to give it time. For example, the S&P 500 crashed at the beginning of COVID and rebounded more than the price it was trading at before the pandemic. This is why long-term investment is the key word to avoid losses in stock investing. Even if your stock's value falls, you can remain invested and wait for the value to bounce back and grow so that you can earn positive returns. If you have a myopic vision, losses would be impossible to avoid. Past performance does not guarantee future profits. Another common mistake that many investors make is to rely on stocks' past performance when selecting them for investment. Past performances can never give you the projected future return. For example, the stock of Jet Airways or Videocon had a good track record for many years before the company went bankrupt. Had you invested in these stocks based on their performance, your investments would have been useless after these companies faced bankruptcy. Historical performance does not guarantee future profits. You should assess the financial fundamentals and have a good understanding of the market the company operates in before investing in it. Study the company's price-earnings ratio, which would help you understand whether the stock is undervalued or overvalued. Investing in undervalued stocks would yield profits, while overvalued ones may not have great potential for profits. Moreover, a company with a strong history of profitability would be financially healthy compared to companies that have not yet generated revenues. So, stock assessment on financial aspects is essential. This assessment would help you understand whether the company is under stress or not, and then you can make the right choice of investment. Stop loss can work wonders. When it comes to profits from stock investing, the sky's the limit. On the other hand, the losses can run into the ground. One way to minimize your losses is to use the stop-loss tactic. Under this tactic, you instruct the broker to sell the stock when it reaches a particular price level called the stop-loss level. This is significant when the stock prices are falling. By selling off at the stop loss point, you can prevent further degradation of returns if the prices fall further. For example, say the stock price is at 2,500 and then it starts falling. You expect a further fall in the stock price and you put a stop loss order at 23,050. Now, if the stock price reaches 2,350, the broker would sell off the stock so that you can avoid losses in case of further devaluation. On the contrary, if the stock price starts rising, you don't have to worry because stop loss doesn't limit your profits, only your losses. Use the stop loss strategy when prices are falling. Estimate the minimum price at which you can sell the stock and still make a profit. Set this price as the stop loss price so that you can avoid losses when the price falls further. Leave your emotions at home when you set out to trade in stocks. How many times have you let your emotions dominate your investing strategy? When it comes to stock investing, practicality matters, not emotions. If you let your emotions dictate your trading activities, you would eventually face a loss. So when you are buying and selling stock, be practical and keep a cool head. Remember, upturns and downturns don't last lifelong. If the market is bullish, it will enter the bear phase after some time. And if the market is bearish, it would rise and become bullish. The stock market is a roller coaster ride with both profits and losses. To avoid losses, you need to be clear-headed about your investments. If the market is rallying, rein in your emotions of investing all your wealth. Go slow. Similarly, when the market falls or enters a downward phase, don't get emotional and sell off your stock immediately. Be calm and take your time. When the market is rising, invest slowly and carefully. Similarly, when the market is falling, don't liquidate your investments. Hold on to them as the market would recover. Emotions might let you make the wrong decisions about buying and selling stock, but when you are practical, you can carefully weigh the pros and cons of the market dynamics and then invest with caution. Diversification is the name of the game. Have you ever heard the saying, "Don't put all your eggs in one basket"? If you have, do you understand its meaning? When you put your eggs in different baskets, if one basket gets damaged or if one egg is bad, you still have other baskets to fall back on. The same holds for stock investing. Diversification should be the mantra for successful investing. Choosing a variety of stocks is vital in preventing losses. If one stock suffers a loss, the other might not, thereby decrease the risk of losses. For example, say you buy two stocks A and B worth $100 each. Now, if the price of A moves down to 95 and the price of B rises to 105, your losses are nil. Even though you have invested in stock A, the profit from stock B has nullified your loss. Though stock trading is not as simple, diversification plays the same role. You should pick stocks of companies belonging to different sectors. This way, if one industry underperforms, your losses would be minimized due to the growth in other sectors. The latest example of diversification one can see in the COVID pandemic. When the pandemic struck, the stock market started sliding due to lockdowns and uncertainty that affected the industry. Stocks of manufacturing companies started falling, but stocks of FMCGs and pharmaceuticals were on the rise. So, investors with investments in different sectors managed to earn profits despite the falling markets because they had exposure in the pharma and FMCG sectors, giving them the best effect of diversification. So, aim for a diversified portfolio of stocks. Invest in different sectors for maximizing profits and minimizing losses. Also, don't overdo diversification. Excess of everything is terrible, and the same is true for diversification. A highly diluted portfolio would fail to give you significant returns from a performing sector. There might even be higher chances of loss. So, diversify, but with reason. Hedge against losses. Hedging is also a useful tool that can help you prevent losses from stock investing. Hedging means cutting down losses from one investment by investing in another. Hedging in the stock market can be done through futures and options contracts or call or put actions. Similarly, when the market is falling, you can hedge your investments by investing in alternative avenues. Like gold. Gold tends to rise when the markets are unstable. This was observed both at the time of demonetization and the COVID pandemic when the markets were in turmoil, but gold prices rose. So, you can use gold or other investment avenues or trade in futures and options to hedge against equity investments. Keep learning. Learning is a never-ending process, and when it comes to the stock market, new rules and regulations are always being updated. Therefore, you should update yourself with the latest changes in the market and the companies comprising the market. Also, master the art of stock investing for an in-depth understanding of the market and how it works. Take online courses, read books on stock trading, understand the strategies of successful investors, and expand your knowledge base. Also, keep track of current affairs that can help you understand which company is poised to grow, to invest in it and grow your investments. You have to be able to adapt. Mindset 101. Markets can change rapidly. Be prepared to adapt your strategy based on changing market conditions and new information. Today's volatile market can definitely be confusing. At times, the market can stay irrational longer than you can remain solvent. At times, what does not make sense will inevitably happen. Always have no bias in a trading plan for both ways and pay attention to price levels, i.e. support and resistance, RSI overbought and oversold. Also the volume on the day chart. Plan your trade. Define your risk. Stick to plan. Patience, strategy, gratification. 2. Good trader characteristics. Flexibility. A trader should be flexible and willing to change positions based on new information or shifts in market trends. Holding on to a particular trade because of emotional attachment can impede the ability to adapt to changing market dynamics. Risk management. Getting emotionally attached to a trade may result in overlooking risk management principles. Traders should be ready to cut losses when necessary and not let pride or attachment drive decision making. Learning from mistakes. Recognizing and admitting when a trade is not going as planned is a crucial part of learning and trading. Being too emotionally attached to a trade may hinder the ability to objectively assess and learn from mistakes. Focus on the positive. Replacing negative thought patterns with positive affirmations can boost trader confidence, keep them composed, and reduce the influence of emotional biases in decision making. Taking a break. Taking occasional breaks from constant market data can help traders step away, refocus, and gain a better perspective on ongoing events. This can improve mental clarity and emotional control while trading. Journal your trades. Thoroughly recording trade decisions, strategies, and emotions can assist traders in assessing their performance, recognizing trends, and correcting emotional biases. Meditation. More traders are adopting this method to enhance their awareness of thoughts and emotions, enabling them to trade based on rational decisions. Follow your rules. Mindset. Green or red. If you followed your rules today, you did the right thing. The markets transfer money from the impatient to the patient. Mindset 101. Read it again. From the IMPATIEA TTOTHEPATIENT. Don't be a pawn in this game. Don't be on the wrong side of the court. It's only Tuesday. Focus and go get your bag. There is no perfect system in the stock market. Mindset. Don't seek the holy grail system that don't exist. Instead, find a comfortable, effective system. This makes it easier to follow rules, control emotions, and manage money wisely. You can't come in here and decide when you want to win or how often you want to win. You have to be here with the right mindset and have a winner's mentality all the time. Admit when you are wrong about a trade and reanalyze. Mindset. The market doesn't care about your ego and feelings. When it's time to cut those losses, it's time. There is no correct way to time the market for perfect entries on a stock, bottom or top, but there have been a few times when I entered a trade close to the bottom and sold close to the top, but I had to realize that that does not make me a better trader. It only means that the probabilities were on my side at that moment, and I also had an entry, an exit plan set. Waiting on perfect entries sometimes will cause you to miss a good trade. At times, my profit target does not get hit on that day, and if I'm trading 0-day expiration, the time feeder, decay will eat my contract's premium alive to death, and the next following day, it usually goes in that direction and sometimes surpasses my target, which means I should have gave my trade more time with further out in time to expiration date, instead of being extra risky on Zarate expirations. 3. Market structure. The market structure stands as the fundamental bedrock of price action trading, forming the basis for almost every decision undertaken by traders in this domain. A comprehensive grasp of market structure holds paramount importance for individuals earnestly dedicated to mastering price action trading. During an upward market trend, the structure will showcase a pattern of ascending highs and lows, signaling an optimistic market where prices are anticipated to continue their upward trajectory. Conversely, within a downtrend, the market structure will manifest a sequence of declining highs and lows, denoting a pessimistic market sentiment. The crux of successful price action trading resides in the ability to discern shifts in market structure, indicating a likely shift from a bearish trend to a bullish one. Keep in mind, by understanding how prices move within the established market structure, traders can effectively identify and interpret chart patterns such as triangles, head and shoulders, flags, or double tops, bottoms. Price movement is often restricted within the limits of support and resistance levels. Price can cross these levels and shift to other areas of support and resistance. It is a commonly utilized approach to comprehend trends, identify possible reversals, and gain insights into present market conditions, proving advantageous for both novice and seasoned traders. Identifying breakouts. Identifying breakouts in trading involves recognizing instances where the price of an asset moves beyond a certain level, often accompanied by increased volatility. Breakouts can indicate the potential for a sustained trend in the direction of the breakout. It's important to note that false breakouts can occur, and risk management is crucial. Traders often use stop-loss orders to manage risk when trading breakouts. Additionally, combining different technical indicators and chart patterns can enhance the accuracy of breakout identification. Keep in mind, volume confirmation. Breakouts accompanied by a surge in trading volume are often considered more reliable. Increased volume supports the validity of the breakout and suggests strong market participation. Trendline breakouts. Price breaking through a trendline can signify a potential change in the existing trend. Retesting. After a breakout, the price may retest a broken level, previous resistance turning into support, or vice versa. Successful retest can offer additional confirmation of the breakout. Price channel. Price channels depict the fluctuation of an asset's value confined within two parallel lines. These lines are drawn to link the highest and lowest points of the price over a specific time. The upper line is identified as the resistance line, while the lower line is termed the support line. The region between these lines is labeled as the channel, and the price's oscillation within this channel characterizes a range. Bound market. Traders must weigh the benefits and drawbacks of trading channels, tailoring a strategy to their personal style and risk tolerance. Thoughtful planning and execution can make trading channels a powerful tool, boosting success odds. In the markets, keep in mind market conditions. Channels may be more reliable in trending markets than in sideways or ranging markets. Confirmation indicators use other technical indicators, e.g., moving averages, RSI, MACD, to confirm signals provided by the price channel. Time frames. Analyze different time frames to confirm channel patterns and identify key support and resistance levels. Exit points. Take profits or exit a long position near the upper trend line. Take profits or exit a short position near the lower trend line. Use additional technical indicators or signals to confirm exit points. Trading volume. Trading volume means the total number of a security's shares that were bought and sold in a certain time. It's a sign of how active that security or market is. Investors look at trading volume to see if a trend is starting, continuing, or changing. Trading volume helps to show if a security's price movement is real. This helps investors decide if they should buy or sell that security. Volume and price trends alignment. Look for alignment between volume trends and price movements. Increasing volume with a rising price suggests a strong upward trend, whereas increasing volume with a falling price indicates a strong downward trend. Use volume with other indicators. Combine volume analysis with other technical indicators and fundamental analysis for a more comprehensive trading strategy. Volume and reversals. A sudden and significant increase in volume can sometimes indicate a potential price reversal, especially if the price has been trending in one direction for a while. Hammer candlestick. A hammer is a special shape in candlestick charts. It happens when a stock starts much lower than where it opened, but goes up before the time period ends, closing near the opening price. This creates a candlestick that looks like a hammer, where the part below is at least twice as long as the middle part. The middle part shows how much the stock's price changed from opening to closing, while the longer parts show the highest and lowest prices during that time. Hammers occur on all time frames, including 1-minute charts, daily charts, and weekly charts. The hammer candlestick is a pattern formed by just one candle, and it requires another candle to confirm its validity. It's essential to wait for confirmation before making any trades based on this pattern. A hammer should look similar to a T. This indicates the potential for a hammer candle. A hammer candlestick does not indicate a price reversal to the upside until it is confirmed. Death cross. The death cross is a pattern on market charts that indicates recent price weakness. The death cross appears on a chart when a stock's short-term moving average, usually the 50-day, crosses below its long-term moving average, usually the 200-day. Despite its name, the death cross does not signal a market milestone to fear. Historical market trends indicate that it typically foreshadows an upcoming short-term recovery associated with returns that surpass the average. Keep in mind, selling activity has intensified enough to cause either a sudden drop in prices or a steady decline over a period of time. Market sentiment may be increasingly bearish, as evidenced by falling prices. Traders who are short a given market may look to the death cross price point or range to help determine appropriate stop-loss levels. Once the crossover occurs, the long-term moving average is considered a major resistance level for the market from that point forward. Trading on pullbacks. A pullback happens when the price of a stock or commodity takes a breather or dips slightly in an ongoing upward trend. It's a bit like a step back or a moment of rest in the price movement. People often use the words pullback, retracement, and consolidation interchangeably. Pullbacks are typically short dips, depending on which time frame you're looking at, before the uptrend continues. In many cases, pullbacks happen when a stock's price drops to a technical support zone, like a moving average, pivot point, or Fibonacci retracement level, before it starts going up again. It's essential for traders to keep a close eye on these support areas, because if the price falls below them, it might not just be a pullback, but a sign of a possible trend reversal. Keep in mind, identify key support and resistance levels. Look for areas where the price might bounce back support levels or encounter resistance. These levels can act as confirmation points for potential pullback entries. Wait for confirmation. Don't enter a trade immediately after a price starts to pull back. Wait for confirmation that the pullback might be ending, such as a reversal candlestick pattern or a shift in momentum on lower time frames. Consider volume. Higher volume during a pullback can signify the strength or weakness of the reversal. Lower volume during a pullback might indicate a lack of conviction in the move. Practice patience. Wait for the right setup. Not every pullback is worth trading. Be patient and selective in choosing your trades. Again, please don't chase. Always wait for a pullback. Trailing stop loss. Traders can make their stop loss strategy more effective by using a trailing stop. A trailing stop is a type of trade order where the stop loss price isn't fixed at a specific dollar amount. Instead, it's set as a percentage or dollar amount below the current market price. Here's how it works. When the price goes up, the trailing stop moves along with it. Then, when the price stops rising and stabilizes, the new stop loss price stays where it was dragged to. This automatically protects the investor from potential losses while also locking in profits if the price continues to rise. Trailing stops can be used with stocks, options, and futures on exchanges that support regular stop loss orders. Keep in mind, traders encounter specific risks when using stop loss orders. To begin with, market makers are highly aware of any stop loss orders you place with your broker. They can manipulate the price to trigger your stop loss, causing you to exit your position and then quickly push the price back up. Additionally, when using a trailing stop, there's a possibility of setting it too close to the stock's early support levels. In such a scenario, the result is the same. The stop gets activated by a temporary price drop, leading traders to worry about an apparent loss. This can be emotionally challenging to accept. Supply and demand. The concept of supply and demand encompasses two essential economic principles that explain how fluctuations in the price of a resource, commodity, or product impact its supply and demand dynamics. When the price goes up, the supply increases, but the demand decreases. On the contrary, when the price decreases, the supply tightens while the demand expands. When the COVID-19 pandemic hit in 2020, causing a significant drop in gasoline consumption, prices promptly decreased due to the industry's lack of storage capacity. This decline in price in response sent a strong message to suppliers to reduce their gasoline production. In contrast, in 2022, the rise in crude oil prices offered producers a compelling reason to increase their output. Tips on supply, demand. When a price repeatedly tests a supply zone and sellers lose their dominance within that area, it transforms into a demand zone or support area, enabling buyers to seize control. Generally, the narrower a supply-demand zone is before experiencing a strong breakout, the higher the likelihood of a favorable response the next time. The profit target may not be achieved every time, prompting traders to consider adjusting their exit strategies based on market conditions. A supply zone usually exhibits limited price movement and excessive candle wicks, and significant back and forth trading activity can frequently invalidate a supply zone for future trading. Head and shoulders. The head and shoulders pattern are widely recognized and easily identifiable. Formation and technical analysis consists of a baseline with three peaks, with the central peak being the highest. It signifies a shift from a bullish to a bearish trend, indicating that an upward trend is approaching its conclusion. This pattern is observable on various time frames, making it suitable for traders and investors of all kinds. With clear entry, stop, and price target levels, it offers a straightforward implementation, offering easily discernible reference points. Tips on trading this pattern. As the price nears the neckline, a significant number of individuals who entered the market during the final upward wave or during the rally in the right shoulder find themselves in an unfavorable position with substantial losses. It is this sizable group that will start closing their position, consequently pushing the price closer to the profit target. Wait for the pattern to be fully formed before trading. This may require patience over an extended period. The profit target may not be achieved every time, prompting traders to consider adjusting their exit strategies based on market conditions. Formations are rarely perfect, so there might be some irregularities between the shoulders and head. How RSI indicator works. The Relative Strength Index, RSI, is a technical analysis tool used to gauge momentum. It assesses the speed and extent of recent price fluctuations in a security to determine if its price is potentially overvalued or undervalued. Displayed as an oscillator in the form of a line graph, the RSI operates on a scale ranging from 0 to 100. Beyond identifying overbought and oversold securities, the RSI also has the capacity to suggest securities that might be poised for a shift in trend or a corrective price pullback. It serves as a signal for opportune moments to buy or sell. Typically, an RSI reading of 70 or higher signifies an overbought condition, while a reading of 30 or lower suggests an oversold situation. Tips on using RSI indicator. Some traders mistakenly believe that the RSI is only for identifying overbought and oversold markets and can't be applied in trending markets. However, this is not accurate. In fact, during an uptrend, one effective RSI strategy involves waiting for the indicator to indicate overbought conditions. Then, when the RSI drops below 50, it signals a potential opportunity to go long. If the trend continues, prices often bounce back from this level and reach new highs. Look for a bullish or bearish divergence between the RSI and the price chart. Divergence can signal potential reversals. Consider using RSI in conjunction with other technical indicators or chart patterns to confirm signals. Overbought, double bottom pattern. In technical analysis, a double bottom indicates a strong support level after a downtrend, and as long as this support holds, prices are likely to rebound and possibly start a new upward trend. When correctly spotted, the double bottom pattern indicates a favorable opportunity for traders to go bullish, as it establishes crucial support against further downside, preventing the stock from breaking below the resistance level and positioning it for an upward trajectory. Upon identifying the double bottom, traders can make well-timed bullish investments to potentially secure swift gains. Formation of the pattern. First bottom. After a significant decline, the market rebounds. It then establishes a swing low where prices drop below any recent prices. It's important to note that this is likely a temporary upward correction in the ongoing downtrend, rather than a sign of a complete reversal in price direction. Second bottom. The market creates the second drop as it adjusts for the previous downtrend, leading to increased buying pressure. This results in the formation of the second bottom, indicating potential signs of a price reversal and uptrend. Nonetheless, it's premature to confirm whether prices will indeed keep rising. Neckline. A double bottom pattern is considered finished when the price surpasses the neckline, signifying an abundance of buyers over sellers and suggesting the probability of the trend continuing upward. ABCD pattern. The ABCD pattern, also known as the Gartley pattern, is a harmonic trading pattern that traders use to identify potential reversal points in the market. This pattern is based on the idea that markets move in repetitive patterns, and by recognizing these patterns, traders can make more informed trading decisions. The pattern can be either bullish or bearish depending on the direction of the initial A to B move. If the A to B move is upward, it's a bullish ABCD pattern, and if it's downward, it's a bearish ABCD pattern. Harmonic patterns like the ABCD pattern are subjective and open to interpretation, so it's essential for traders to develop their skills and judgment when using them in their trading strategies. Keep in mind, A to B. The initial price move is from point A to point B. This move is typically a significant and often sharp price increase, upward or downward. B to C. After the A to B move, the market retraces from point B to point C. This retracement is usually a counter-trend move, and it should be a Fibonacci retracement of the A to B move. Common retracement levels used are 38.2% or 61.8%. C to D. From point C, the market starts moving in the direction of the initial A to B move. The C to D leg is expected to be of similar GP magnitude to the A to B leg. D. The point D is where the C to D move ends. This is the potential reversal point, and traders look for confirmation signals such as candlestick patterns, RSI divergence, or other technical analysis tools to determine if the price is indeed going to reverse. Advice versus reality, facts and fiction. Common advice: start putting your money into investments now or you'll be broke. The reality: act promptly, but don't rush. Making bad choices can make you lose even more money. Common advice: to begin investing, you need to have a lot of money. The reality: having a lot of money to start investing is helpful, but you can still begin with small capital. Common advice: following what other people are buying. Buy the reality. Many of the popular choices you find on the internet are based on excitement and may not be the best. Make sure to research and check things out yourself. Common advice: investing is all about reading news and following trends. The reality. While reading the news and following trends is good, smart investors use a system to make a calculated risk. Protecting your capital should always be one of your top priority mindset 101. That is why risk management is very crucial. Learn it, practice it, and implement it, learning and improving raw along the way. Mindset 101. There are no shortcuts out here, man. Only consistency, hard work, and a trained mindset. This is a game of patience. You keep taking those small profits. In time, you'll have stacks of them. Consistency is always the key. Only trade true intrinsic value options on 0-day expiration. Always hedge. Going into the market close, if you buy a 4,490 put for 500 in the last 15 minutes, buy protection 4,485, call for $30 that way. If the market pushes the put out of the money, you will at least make your 500 back with the hedged. Call option. On a bullish or bearish day where SPY move 4 points or more from low to high or from high to low and is consolidating, look at SPX option chain chart and look to buy SPX. Contracts that were over 150 at the lowest point of the day, look to buy them for $50 into close when premium prices are at true value. Ultimate strategy. 10-minute rig close set buy order. Only what highest resistance is worth on put and set by lowest support on SPX call. Always look. Analyze it from both ways. Only trade overreactions, only buy support, only short resistance. Only observe the marker until the good opportunity presents itself. Having sell limits set saves. Always have a hedge position just in case. The larger the gap, the greater the odds it will continue in that direction on that day. When you are in an option call or put and it hits your target the first time, don't rely on it to go back to that same price. After a pullback may come back towards it, but never hit it again on the day. If you enter a trade and you are wrong and it goes way out of the money, if it comes back from 6 to 3 to 10, exit the trade and get out. Have the patience to trade once or twice per week and wait for the best setups that will pay out. If your call or put will not break support or resistance into close 20 minutes before the closing bell, but the cheap call or put to hedge your position. Set buy and sell limits. 4. Have a trade plan. Have a plan for both entry and exit and identify ranges and key levels. Always check for volume before entry on trade. More vol than average, better confirmation, less vol than average. Lower confirmation. Look at the year chart for support. Look at 5-day chart for resistance. Before you enter any trade, you must have a predetermined plan and a solid trade thesis. 1. Conditions. 2. Time frames. 3. Targets and stop losses. 4. Position size. 5. Managing the trade. Follow your plan. Trust your process. Do not let your emotions do the trading. Let the chart do it. Patience, strategy, gratification. Trade the trend. Before you enter any trade, you must know the type of trade you are looking to put on. Scalp, shorter term price movement, quick intraday move, fast entries, and even faster exits. 2. Trend trade, day trade, holding for a bullish or bearish trend, longer than a scalp as you are capitalizing on a larger range move. There are only two ways I sell a position. 1, if my target hits. 2, if my stop loss triggers. Everything else in between is noise. The market isn't going to move straight in your favor all the time. Pullbacks, bounces, and consolidations are completely normal. They should not freak you out. This means you are focusing too much on the and letting emotions get involved. Mark price levels on the chart. Pre-market high, pre-market low, previous day high and low on the 5 or 15-minute time frame. Stop being afraid to take a losing trade. Trading out of fear means we are too focused on the risk and are unlikely to capitalize on the full reward. How to avoid the fear of losing. 1. Have a trading strategy plan that's proven to work consistently. In the long run, supply demand. 2. Remove the guessing out of your trading. Ego greater than market. 3. Change your mind state. You have to lose in order to win. 4. Focus on 3-1 risk reward. Losing trades don't matter. 5. Give the trade more room to breath. Larger position size, tighter stop loss, smaller. Position size, wider stop loss. The trend is your friend. At that moment, momentum play of the day. Trade the chart, focus on setup. If it's choppy, exit. You can always enter at a better price. Only ride up a strong green candles on the -5 minute. Stick to high probability setups. Good fundamentals, catalyst, relative strength. Market cap, high conviction, social trends, news, catalyst. Oversold at 2-week support tends to rally back up, overbought at resistance. The fall back down. Ticker does not have momentum. M, it may consolidate and trade in a range or light Fibonacci retracement channel. Adapt to markets. Every 2 to 3 days will be a different hot or cold sector. Before trading, ask yourself, is my mind state good to trade now? Manage uncertainty. The outcome cannot be controlled. Always trade what you see and not what you think. To become a long-term, consistently profitable trader, you must train your brain to acquire the mental skills you will need. Stay focused on the process of trading and not the results or consequences. Trading outcomes are unique and random, never the same. Inconsistent returns can be maintained over time in the market with an edge over a series of trades. Rome was not built in one day. Be patient and consistent. Think in probabilities, do not have expectations. Avoid mental pain, i.e. disappointments, and feeling betrayed, which will cause you to misinterpret market action and can disable you from entering winning trades or not be able to exit a losing trade. Trading is not about being right or wrong, especially in this kangaroo market. You can be both right and wrong at the same time. It is the odds of other buyers coming in and bidding higher than the price you brought at, or if more. Sellers will come in and offer to sell lower than you sold. Have a probability mindset. Be a sniper and not a machine gunner. Have the discipline of a ruler. The courage of a warrior. Be comfortable. Self-soothing morning meditation is a good start to trading. Focus on performance amp, not outcome. Be attentive in the moment. Do not be hypnotized. Pay attention. Think, though not be indecisive. Process the brain for emotional enrichment and symbolic mind representation to retain the mind from managing challenges of uncertainty. Build the mind that thinks in the moment of performance. I'm not my thoughts. Convert the brain from surviving by fear and aggression. FUD. 2. Engaging uncertainty with a probability mindset. Get comfortable being uncomfortable. Tier trade in and out. First strike with low size as trade shows strength. Scale in as hit targets. Take profit and tier out to lock in gains. I will cut losers quickly and have no hope in a stock if showing weakness and fails to hold support, especially if the SPY is failing red. Exit. The last 30 minutes to the bell shows the stock's true strength. Eat if stock opens strong and closes weak. Vice versa, in a bull market, stock will close strong. Above 200-day moving average is bullish, below is bearish. Do not have hopium-only conviction setups. Study chart and setups for plan before open and during the session. Check sectors, performances, volume. RSI is more effective on the 4-hour. Zoom out and look left to verify the trade. Use extended after hours to see support and resistance. Only trade large volume stocks less likely to be manipulated. If you are long call on overbought RSI, as soon as hit 50 line from 80% sell call. If short, put oversold as soon as it comes back to 40% sell put. Set target alerts on TradingView for support or resistance and most. Volume on volume profile. Follow Google Trends for stocks momentum and interest. Before entering trade, look at timing rates, inflation, economy, yields on bonds, supply chain, dollar, tapper news, macro economic conditions to market. The world, what's going on? Geopolitical risk. 2. Fundamentals on company. 3. Thesis. Why am I doing trade? 4. What would stop me out? 5. How do I take the trade? Offer 4 different ways to execute strategy. At the opening bell, watch key levels, pre-market highs and lows. Previous day's last high and low. Pay attention to the first volume bars, volume for strength or weakness. Check if RSI is overbought or oversold. Is MACD trending green or red? Watch to see if pre-market low or high holds or breaks. These are all key factors in determining a trend for the day's price action. Can help for a quick in and out scalp, or with a strong trend can be a day. Trade unusually after 3.5 to 4 points on the SPY, and QQQ the trend may reverse or have a significant pullback or pop up to VOB. May want to take profits at those psychological zone areas. Can ride trend if going up or down, riding the 5 or 7 moving average, and of course over VWAP tends to be bullish and under VWAP tends to be bearish. Watch for key support or major resistance levels on the daily chart. 4 hours, 1 hour, 15 minutes for bounce, reject, or breakout. Remember, take profits when the market is overnighted on a big breakout or breakdown. Trim some, especially if your gut is telling you, here is my target. Take some off table. Let other winners run or loose. Value. That way you already secure some of your bag. Protect profits, set stop loss. It's imperative to do that in this market or have a solid exit strategy. Cut losers quickly. It does not make sense to hold losers to zero. We must protect our capital by all means. One thing I noticed about myself is I always average down on losing trades. The more it went against me, the more I averaged down. In some situations, that may help your trade by managing the trade, so when and if you get a reversal to your side, it will accumulate the gains to be able to break even, turning a losing trade into a winning trade and sometimes turn it into a big winning trade. But that strategy, I have learned from experience, is risky. And even when you get back in profit, your mind will be released from recovering losses, making you want to take profits and exit the position. But at the end of the day, it all depends on the market environment fundamentally and technicals of that day. Some people average up on whining. Trades that can be profitable also, it's all dependent on the momentum of that time to upside bullish sentiment or downside bearish sentiment. Follow the trend until it bends. Know your buy-sell levels in advance. Using limit orders will translate into a better execution, and it will also help you avoid making trades based on emotions. The solution to stop forcing trades and to be more disciplined and patient. Use limit orders instead of market orders. You don't force trades. You let the market come to you. Making money is an action. Keeping money is a behavior, and growing money is knowledge. 2-step process for entering trades. 1. Play levels. Identify and create levels of interest. Key levels or supply and demand. React to the market at your levels of interest. Spot buyers and sellers at your levels of interest. Tape reading, related markets, volume chart, etc. Without either of the two coming together, we do not have a trade. 2. 3. Have a plan and know targets, when to get in and when to get out. Have a system. If does not work, modify it or exit, re-enter or find a better trade. BDBR buy dip or buy rip on a stock that has been consolidating. Wait for confirmation. If it does not meet my criteria, do not risk your capital. Only high-quality setups oversold on 4-hour. Expect a rebounding leg up overextended on short-term 30-minute day chart. Expect a pullback. Always check different time zones on the chart for outlook. Watch for overnight gap fills. Watch for bull flag or bear flag for reversal entry. Use ES Futures chart to track the SPY. Ask yourself, is this trade in line with my risk management guidelines? Is this trade in line with my trade plan? Do I know where my entry trigger should be? Do I know where to exit the trade if I'm wrong? Are the fundamentals on my side of the trade? Do I have an in-trade management plan? Do I feel 100% confident with the trade I'm about to take? For beginners, I recommend starting off trading shares instead of jumping into options that are risky but have more potential for higher reward or practice with. Paper trading. 5. Set and follow rules. Trading rules. One system must be designed for big wins and small losses. 2. Your trading system must be built on quantifying able facts, not opinions. 3. Look for low-risk, high-reward probability setups. 4. Answer the question, what is this trend? Is the question, what is the time frame? 5. Start with a weekly chart to establish the long-term trend and then work down to daily and hourly charts to trade in the direction of trend. The odds are better if you are trading in the direction of a long-term trend. 6. The more times the support or resistance levels are tested, the odds it will be broken. 3 to 4 times, usually old resistance can become new support and old support becomes new resistance. 7. Moving averages can quantify trends. I create signals for entries, exits, and trailing stops. 8. Bull markets have no long-term resistance and bear markets have no long-term support. 9. The larger the market gaps, the greater the odds for a continuation. 10. The last hour often tells the truth about how strong a trend truly is. Smart money shows its hand in the last hour to trap short or to trap longs there. Having consecutive strong closes, look for a continued uptrend may be likely to happen, but it may end when there is a morning rally up, followed by a weak close. 11. Above the 200-day MA is bullish for uptrends and downtrends. Happen below the 200-day moving average. 12. It's much easier to watch a few stocks than many. 13. First sharp dip always finds buyers and first big rip always finds sellers. Reversals build slowly. 14. Successful trading is about doing the difficult thing so often that it becomes second nature. 15. The best trades almost work right away because if you plan, the reward will shower in charts price action. 16. Wishful thinking must be banished. Hope is not a trading plan, not a strategy for trading. Be ready to go, have funds ready for the opportunity to increase. Look far left on chart for key levels. 8. Look down all the way. Check MACD, then RSI for confirmation. The higher the market cap, the easier for stocks. 70% go up strong, and the lower the float, the easier with more volume to squeeze up. When volume fades, price fades. Look for gap close reversals. Set price alert a bit before target to allow time for entry, but has to have volume inflow. VPVR red midline is a strong indicator of support or resistance. Most volume traded. A new strategy start with one contract on super trend buy or short. When the CCI trend says long, add contracts. Momentum Chanel indicators use 1 minute for scalp, same day 15 minutes for long day, 4 hours or day chart for weekly swings. Identify and mark key levels on the chart for later reference opening. Price, yesterday's high or low, pre-market high, pre-market low. Watch psychological levels X240, 72. Always look 2 levels for support on Fibonacci retracement channel. Always check vol and open interest before entering trade. Be patient. AMP, wait for the best setup and tear into the trade. Make this promise to yourself. Holding and hoping is stupid, and I promise from now on, I will not do it. If the trend fails and breaks support, I will exit the position as soon as possible. We will not lose more hard-earned money, and will wait for confirmation and tear in. Always check volume before enter. Check bar chart Volume leader price and vol advances if not listed do not trade for long or short. Trade. NT&T. Sometimes no trade is the best trade. Doing nothing in the market and analyzing and waiting for a proper setup is doing best for the best overall. Outcome. Sell at your targets. Law of propensity. Small gains add up, and slow advancing compound interest is the best, safest way to trade the markets. This strategy requires patience and time, but will pay out nicely over time. Take more smaller profits. 15 mean is 20% safer. Better take 10% gain than 80% loss. Tickers are much easier to fail than go up, depending on the market sentiment. Small profits compounding interest adds up over time is the only real way to become constantly profitable. Just like the casino, they take big losses and big gains sometimes, but it's all random. But they do have a set algorithm for profit quota they are guaranteed to make. 1.7% of total money every day, which can be over 8 million a year. Become the casino instead of the gambler and make compounding smaller gains over time that will add up to amounts that you will be able to live the life that you deserve and is destined for your hard work and effort. And since most options usually expire worthless, best to sell premium and collect risk income. Pay attention to price action and volume. Look left on 15 and 5 minutes. Use Apple as a gauge to take profits on QQQ or SPY at resistance. You have to be active in this market, especially on a Friday zeroed. Everything after 3 is mostly worthless. 10-minute rig can be profitable. Into after hours with heavy volume. If you are up 250% to 300% on a Friday most, it likely means it's time to take profit before reversal. 2.55 point move rule up and down on SPY. Set sell limits. Liquidation. If a heavy bearish day to close will tank lower after pop. If a heavy bullish day into the close will rise higher after the drop with good momentum, but still should manage trade and take profits on the best bid limit price. NT&T, no trigger, no trade. Trade the chart lines, not the headlines. When consolidates in a channel for more than 6 days, means it's getting ready to break out in a big move in the direction of sentiment movement, bullish up or bearish down. If your option contract is not in the money on 0-day expiration towards close, do not hold into close, will be worthless. If momentum is not in the trade. Direction. If a call or put goes up 120% out of the money on a Friday, take profit. ASAP before fast reversal end of the day will be worthless. On a Friday, market makers typically run it up the first 30 minutes of trading open to manipulate puts and kill put premiums also. Bull traps so their sell orders can get filled on the rug pull. Watch the bid for previous days high resistance or low support. Manage premium and take what you can get. If going against the trend and get 90 to 100% on SPX, quickly take profit, which may be VWAP before reversal. Look open interest, go where the money is. Watch consolidation for a breakout in the direction of movement over VWAP or under VWAP. Trading is about protecting what you can lose, not what you can gain. The last 15 minutes of trading can do in the money SPX in the direction of momentum YOLO with a low amount. Sometimes being in a bad trade turns out to be a profitable trade, and sometimes being in a good trade can turn out to be a losing trade, because the market sometimes as the opposite reaction. For example, buy the rumor, sell the news. Example, earnings on a stock may fail, but the stock may still go up because it's already priced in for a miss, and the company may give good guidance, or a stock may beat earnings and the stock might tank because the why gave bad guidance. It all depends on market sentiment at the time and where the microeconomy is. Pay attention to the daily chart will tell the story as it unfolds. Sometimes in trading, I look back and see. It was telling the whole time, just look left for major support and resistance in the DA. When everyone is over bullish, may be a time to be bearish, and when everyone is over bearish, may be a time to be bullish. Just have patience and give your trades time and manage accordingly. After FOMC Fed meetings, we'll have a big movement in markets to fill in the missing information. Prices of the puzzle for confirmation continuation to an uptrend or downtrend. In markets do not like uncertainty, but I guess if there was no uncertainty, there would not be as much of a volatile market. Profitable smart trading is about risk management. Use smaller amounts to make bigger profits. X risk $1 to make 3 minus $4 instead of risking $4 to make 8. Compound interest add up, and if you stay consistent and profitable, you will be able to survive to make big gains over time. It's good to meditate before trading. It's imperative to have a positive, clear thinking mind when and before taking a trade, to be mindful and analyze the chart and momentum for a high probability setup. Do not overthink in trading or try to take the perfect entry or exit, because the trade will go in the direction you anticipated without you. Do not try to rush a trade instead of chasing a trade. Let the market come to you. Use limit orders instead of market orders. In a bull market, old resistance can become new support, and in a bear market direction, old support can become new resistance. On a big gap down day, have the option can already be open to get the lowest cents price for options. Call as soon as hit gap fill or close to it to sell. X Apple 165 strike price on Friday opened 5 minus 10 cents within 35 minutes from opening bell. The contracts hit 1.25 when Apple went green, then retracted back forward to 30 cents. That's 1,200% in less than an hour. Do not force a trade or have FOMO. If you miss entry, there will be another entry trade better price. Know that. Remember that. Pay attention to pre-market price action. If a stock is weak or strong, breaking down or out for relative strength compared to other tickers, it is imperative, very important, to cut losing trade if come back to break. Even price exit trade, especially if down 20%. Pay attention to Bitcoin spike ups or gap downs for relative market action. Always put on a hedge trade when uncertain on big gaps. On a gap down, look for previous day's support to become resistance. Buy options at the break-even price for target. Look left for the support target. Smart money takes profit resistance or support targets. One stone red candle. Sell. The markets are greedy. The best comfort zone in this bear market is to have all positions closed by end of day and liquidity ready for the next day's best opportunity. You can buy into strength the same way you buy into weakness, vice versa. You can short into weakness on a strong downtrend. Entry does not have to be perfect to ride the momentum trend until the reverse. As long as under VWAP, you can hold puts on a strong downtrend, same as over VWAP on a strong uptrend with volume. Watch volume will tell the strength. Watch for overreaction to upside or downside for next day reversal. Never have too much conviction. If you are uncertain, play both sides, call and put. Always pause and think before entering trade. Does it make practical sense? When stocks have been rallying too much, overreacting, or falling too much. Overreaction, it may become enough for a reversal. Learn to use stop loss and apply it every day to protect assets. Have no bias. Every day is unique. If the volume is low on your side of the trade, exit the trade and re-enter. Always take a small position, tester, before risking your decided investment. Obtain at least 4-5 positive confirmations before taking a position. Start with one stock and master it before venturing out into other stocks. Only trade companies with a catalyst so you will have a reason for the movement. Paper trade first and make your mistakes with fake money. Control your emotions and fears. You cannot predict the market. No one can. Don't be greedy. Take what the market gives you. Don't trade with the money that you need. Only trade with up to 5% of what your account balance is. New traders should only start with 1%. Do not overtrade. Overtrading is very dangerous, especially after a big gain or big loss. These rules are easily said, but I have to actually follow them and not procrastinate. I have lost a lot, made some back, and said I would have good risk management. Then the following day lost most of it by not being disciplined in following my rules. I have to apply them. I cannot predict the market. All I can do is be patient, wait for confirmation, and play the chart. Don't let your mind play tricks on you. Buying volume may come in after candles, establish a base over VWAP, and Hold over after retesting the wick off vol. Continue to follow your plan. Do not steer away. Be disciplined and take profit target. Most of the time, it's best not to trade the market open and wait for patterns and good setups to form. Wait until the premium is cheaper. I am making a commitment to be disciplined and trade exactly to the rules. I will make it a priority and habit like second nature and respond mechanically and automatically. Make up your mind to have a desire and skills to trade the markets based on strategy and goals rather than the outcome and money. Have a mechanical robotic system, entries and exits, less judgment and guessing. Trying to extract money from the markets fast is usually a setup for failure and is the wrong approach, but with time and patience, smaller gains in the market tend to be a key for success. Plan your trade, define your risk, stick to plan. Reasons why beginning trader fails. They are unable to cut losses and hold losers with hope. They think trading is a get rich quick. They try to overtrade to make a profit, chase plays on FOMO or misplays from being scared of entering. They don't have a plan and gamble their money. If price volume and your gut is telling you your trade is invalidated, exit the trade and reassess, re-evaluate. The next high probability setup, patience or forbearance, is the ability to endure difficult circumstances. Patience may involve perseverance in the face of delay, tolerance of provocation without responding in disrespect, anger, or forbearance when under strain, especially when faced with longer-term difficulties, or being able to wait for a long amount of time without getting irritated or bored. Patience is the level of endurance one can have before disrespect. It is also used to refer to the character trait of being steadfast. Antonyms include hastiness and impetuousness. 6. Psychological, MINDSET. Trading psychology. 1. Know your strengths. 2. Develop confidence. 3. Know your weaknesses. 4. Know when to take a break. 5. Become self-aware. 6. Learn to change. 7. Control your environment. 8. Deal with stress. 9. Pinpoint your emotions. 10. Develop a routine. 11. Challenge your ideals. Never think you know what the market will do. Start with a positive winning attitude. Only react and do not try to predict. Ride the wave of what the market will give you that day. Have no bias. Remain objective. Know when the market does a certain move and you see a certain pattern, you will know how to execute. You cannot control the market, but you can control your emotions and actions. Markets have different favorite stocks every other week or so. Must have discipline. The practice of training people to obey rules or a code of behavior. Using punishment to correct disobedience. You must trust yourself to be objective in making decisions to act in your own best interest. Follow the rules for success. We make decisions every day, and our daily decisions compound and create our future. If you don't have discipline, you're not in control of your decisions. You're controlled by your moods and emotions, which leads to poor decision making. Focus and live in the present moment. Focus on the present moment. Being in the present moment is where you will have the greatest control, where you will feel the most at ease, and where happiness flourishes. There is a super tight connection between happiness and the ability to live in the present moment. Staying present is the skill of having your mind in the moment, not in the past, not in the future, but right here. Stay consistent. Life is a journey. Success is not a one-time action, but a continuous process. There is no time to mourn over your failures because this wastes time, but just pick yourself up and keep moving on. Success is not a destination, but a process of consistency is a journey. Self-reckoning fear and big gains euphoria can be the biggest risk in trading. Stay humble and open-minded at all times. A win too big can make you trade with too much size and not have proper risk management, and a big loss can make you imperative and disabled, not able to enter a winning trade when the odds are in your favor. I believe in uncertainty. Which direction will the market go today? I do not know, but I can put on a good probability trade in the direction of the momentum trend on the day or 4-hour chart. 30-minute, 15-minute, 5 minutes that will make sense if the odds are in my favor. Be strict in rules and flexible in expectations. Observe yourself when trading and monitor decisions. Treat trading as your business and you are the CEO. If you trade poorly or good, you will be at full responsibility for the outcome of your trading profit and loss on the day. So be an overseer of your own decisions. Then analyze and act. Pay attention to your thoughts. If you seem to feel hopeful in a losing or winning trade and seem to be immobilized, automatically activate your higher, smarter, radical self to act in the moment. Set sell limit if not sure of the outcome, to take profit of what the market is offering at the moment. Do not be addicted to random rewards. New rule: only trade overreactions, only buy support, only short resistance, only observe marker until a good opportunity presents itself. Having sell limits set saves. Always have a hedge position just in case. The larger the gap, the greater the odds it will continue in that direction on that day. When you are in an option call or put and it hits your target the first time, don't rely on it to go back to that same price after a pullback. May come back towards it, but never hit it again on the day. If you enter a trade and you are wrong and it goes way out of the money, if it comes back from 6 to 3 to 10, exit the trade and get out. Have the patience to trade once or twice per week and wait for the best setups that will pay out if your call or put will not break support or a resistance into close before 20 minutes before the closing bell. But the cheap call or put to hedge your position. Strategy: 10-minute rig close set by order. Only what highest resistance is worth on put and set by lowest support on SPX call. Always look and analyze it from both ways. Domination, motivation. I am a consistent, profitable trader. I am a constantly profitable trader. I have a winning attitude and I maintain a humble, attentive, observing mindset. Think into existence. Have the power to trade like a robot when the trend changes long from short or short from long, switch trend and go the other direction. Align mental environment with the flow of the market. Be in sync. Align mental environment. The fundamental truths. 1. Build the self-trust necessary to operate in an unlimited environment. 2. Learn to flawlessly execute a trading system. 3. Train your mind to think in probabilities. 4. Create a strong, unshakable belief in your consistency as a trader. Principles of consistency. 1. Objectively define my edges. 2. I predefine the risk of every trade. What will I lose? What is the probability of gain %, entry and exit? 3. I completely accept the risk, or I am willing to let go of the trade and cut losses if wrong. 4. I act on my edges without hesitation or reservation. 5. I pay myself as the market makes money available to me. 6. I continually monitor my susceptibilities for making errors. 7. I understand the full principles for success, and therefore I never violate them. Stay focused in the now opportunity of money flow. Every moment will truly be unique. Be objective and have unknown probabilities of price action. Only react to the flow. Have no commitment to any particular outcome of what will happen next. Just observe and react. Be confident in your abilities to appropriately respond to whatever does happen in the market. Don't trade your opinions, trade the action. Keep these principles with you when trading and go over them daily when you find yourself retaining away from any. Observe yourself and get back in line with self-discipline. Refocus, never stop studying and learning, staying in tune. This will help you produce consistent results, identify choppy market and trending markets. Focus on growth and improvement. Evaluate your trading relative to the opportunity set. Do not become mentally disabled when a trade goes against you. If lose 40%, that may be a time to cut losses. Allowing it to go to zero is not smart. Best to save what can to be able to trade another day. Doesn't make sense to Have anything to trade next? Better trade. Make a commitment to be disciplined and trade exactly to the rules before putting on a trade. Make sure you are the right state of mindfulness, open to all outcomes and prepared to act on managing and taking profits when needed. Hedge both ways if unsure. Call and put. Chart candlesticks, not what you think. If need be, patient and wait for confirmation. This will save you a lot of money and give you better entries for better returns. Confirmation. This will. Chart candlesticks, not what you think. If need be, patient and wait for confirmation. This will save you a lot of money and give you better entries for better returns. Pay attention to volume and levels. Do not revenge trade. Do not be reckless in trading. Have a plan and take profit targets. Stay focused on what you need to learn and have the willingness to adapt. Apply it. Remember to have stop loss limits. Believe in your rules. Believe in your strategy. Realize the potential that will be presented to you. Trust yourself to cut your losses. When in a losing trade, remember you still have the power to close the trade. If seem to have fear of missing out, desperate to enter a losing trade, your mind may be playing tricks on you, causing you to see what's an illusion and is not there. Take a look, the chart, analyze the situation fundamentally in levels, then make the wise decision to enter the right side of the trade that will make sense at the time. Train your mind to handle mental stress like military. Common signs of greed. When ambition reaches a point where decision-making becomes compromise, that's greed. Greed ignores all risks to earning money without following proper risk management or following a trading system. When traders suffer from greed, they often think that things will go their way forever, or in fantasy land of an insane profit that you want to make, or even imagining what you'll do with the money when you make it. In short, you are not even assessing the setup. You are only focused on making money. Over the next 2 weeks, journal these things as the trading day progresses to capture where the underlying greed is at. Thoughts, emotions, behaviors, actions, changes to decisions, trading mistakes. Once you have finished, assign a number 1-10 to the severity in the greed through the previously mentioned greed factors, 10 being the highest. In order to resolve your greed, you need to determine what's the driving factor. Wake up and think in the moment. Do not be in a routine. Think. Adapt to different changes in the market. Have a positive mindset. Be patient and wait for setups. There will always be another day to trade. The market never stops weekly. The question is, will you have money available to take the proper setup trade when it presents itself? Do not have fear when trading. Learn to trust the process. Learn how fear blinds you, not able to see the bigger picture, and then you can anticipate how fear will make other traders react. Must get over psychological damages from past trades that will generate fear. Open your mind up to being focused on what the markets are telling you. Be creative, have a strategic plan, and increase confidence to respond to the market with good execution in a timely manner. I have deep pride in following my plan and sticking to my strategic rules. Don't get entangled too much into the news. Trade the chart, not the news. Think positive affirmations. I will be on the right side of the trade. Before entering trade, know where your exit is. Get in, get up, and get out. Lock in profit. Remind yourself how much you can lose. Risk management. Eliminate and execute your losing trades immediately. When low signs of reversal, cut the trade out before it takes you out. To help to be fully aware and attentive to the market environment in the morning, we must get a good night's rest, wake up, eat healthily, meditate, exercise, and have a positive, clear, and open mindset. Set a few high priority goals and work them hard. Each fear affects interpretations, feelings, affects our emotions, and emotions affects our behavior. Even after winning trades, study the chart to see what you could have done better. If get big gap up or gap down, sometimes can use futures markets for reference of retest of support and resistance. Difficulties strengthen the mind. Master your trading mentality. Treat trading like any event in life. Don't go in with a losing attitude. Realize all market data is neutral. It's how you interpret for your results. Trading is all about putting the probability of a successful trade in your favor, understanding that the movement of all stocks is random. No one knows where a stock is going. If it's successful, not during different streaks. Don't hodl 0-day SPX contracts targets unless you sell some and YOLO a few to gamble. Once they lose momentum in the direction of your trend, they will lose value fast from theta decay, delta, and IV crush from any pullback. The 3 development modes of trading. The mechanical stage. Rigid criteria define your edge. All execution decisions are made in advance of market activity. The market either conforms to the definition or not. Execute based on your plan. The subjective stage. This is a broader, more flexible mode of trading where you use everything you have learned about the nature of price movement to determine your edges. The intuitive stage. This is the most advanced mode of trading. It would be the equivalent of getting a black belt in martial arts. It is when you find yourself in the zone, tapped into the collective consciousness of the market. This gives you a sense of the flow. The professional trader is no longer susceptible to these typical trading errors because he has learned to think in probabilities. The benefit of thinking in probabilities becomes evident when you understand the relationship between how prices move and the mathematical formulas and price patterns that make up a trading methodology. This understanding helps you quantify that price movement into tradable edges. Psychology. Does trading involve psychology? Indeed, it does. Psychology in day trading refers to the mental and emotional factors that can influence a trader's decision-making and overall performance. Hands down is the hardest, most important part of trading to conquer, as it is strictly dependent on the trader and what they lack struggle with in terms of the mental and emotional aspects of trading. What are the most common emotions? Day trading, as we all know, can be very stressful and involves a lot of emotional activity. And we as traders must be able to manage our emotions in order to make sound and rational decisions. The most common psychological factors that can affect us include fear, greed, and overconfidence. Fear can cause you to hold on to losing positions for too long, while greed can lead you to impulsive buying, FOMO, and over-leveraging. Overconfidence can cause us to ignore risk management and take on excessive risk by over-leveraging. Understanding and managing these psychological factors is the key to being successful in day trading. How to combat the struggles of trading's mental gymnastics. Understanding who you are as a person and who you are as a trader will help define your edge in the market. Combating the struggles we all face in terms of the mental aspect of trading is a never-ending battle. But what we can do is be proactive. Trading is much more than pressing buy or sell. Understanding that what happens outside of the market also affects your trading. You could have a bad day or night that puts you in a bad mindset for that trading day, resulting in a poor trading performance. Making sure you are in the right mindset, focused and prepared for the market each day is more than half of the battle. This is a career and job just like anything else, so make sure you are treating it as such. Including paying yourself. Would you go to work for 40 hours a week and then tell your boss not to pay you? No, you wouldn't. So if you are profitable or even green for the week, withdraw those profits and make it feel real. 7. Risk management. Do not focus on entry, focus on risk management. Calculated risk position size. I wait for the market to make its move. Then attack the trend. Manage uncertainty, have emotional discipline. The market has no structure, therefore you have to be your own structure. Implement and apply the rules as your trading guide to success. Accept responsibility. Pay attention to setup, focus on trade. Stay constant with your rules. Risk and probabilities. Think of trading as a business that operates based on probabilities. The market is a random environment. Anything can happen at any moment. Probability and statistics. Understand the risk and probabilities involved and you'll have peaceful trading. 1. Trade only proper risk to reward trades. 2. Trade defensive. Look chart. RSI oversold to overbought below VWAP going into close. Bearish above VWAP going into close bullish. When in doubt, zoom out. Look far left for support back to pandemic. Levels. Look up Google Trends to see tickers. Relevance to momentum. I will always cut losers quickly. Always have a plan before entering trade. Do not enter just because it's oversold or overbought. Know your entry and exit and execute as planned. Take profit at target. Support or resistance. Small gains add up better to make 15% return than to lose 80% loss. Manage risk position size. Think, what are you thinking? How do you feel? Set stop loss. Take profit. Be patient. Have a plan. Follow plan. Know your system to grow your account. Even if you have high conviction in a stock, I believe it will go lower. Or more, take profit target or resistance level and make buyback as support and make your position size. Free, let the remaining winner run to next resistance. Keep losses small, let winners run. When trade is going against you, with volume stop being disabled, and exit trade to save some money, to trade another day better, to have something rather than nothing. Learn how to lose properly. Close losing trade. I will never be able to accumulate and keep profits if I never get out of my losing trades. Do not let being stuck in a losing trades risk losing high earnings. In a winning trader, if you find yourself in a losing trade with high volume to the opposite side, might be best to stop out, test a VWAP, and save what you can. If you bought contracts, $4, they come down to $1 to 80 cents VWAP. You should be able to sell for $2. Pay attention to volume on a downtrend or uptrend. If volume increases high on a downtrend followed by another high red volume, hold red candles. On the 5 minutes until base out or hit key level. If get high volume, sell, followed by high volume buy. Get sell, limit order, ready for the retest before. The reversal, same as on upside. If looking at puts or calls pre-market, ask myself, where is my hedge? Where will sellers be willing to buy? And where will buyers be looking to sell? Overall bigger picture. Know your risk tolerance. Only risk what you are willing to lose. Why traders fail. 1. Spend time looking for a holy grail. 2. Trade without a proper plan. No risk. Management. 3. Do not focus on the psychological side of trading. 4. Do not treat trading like a job. 5. Rely on too many indicators. Providing liquidity for smart money. Sell calls targets. Puts in a bear downtrending environment. Follow the trend. Only high volume stocks. The trend is your friend. New catalyst changes weekly. Dollar cost average, invest in good companies like Apple, Tesla, Microsoft, Google, Amazon, ETFs SPY, QQQ long term. 8. Analyzing trades. Wait on confirmation on SPY daily chart. Wait for oversold or overbought on RSP. And wait for wick green candle reversal to upside GR strong green. Candle, not a red candle to go long. Vice versa on the short side, wait for reversal trend candle on the day chart to go short. Swing. Pay attention to wicks on the weekly chart. Support to the upside and resistance to the downside, engulfing candles. Be a comfortable protective risk taker. When Bitcoin and cryptocurrencies start to rally back up, it's considered a risk on environment. Stock equities will trend higher until the trend breaks for risk off. Pay attention to trade line MA break price action when trade reverses sell position and switches direction, forming wicks at top resistance or wicks R. Bottom support. 4 minutes 5-point move. Remember to take profit at target. Watch for entry of RSI oversold to overbought, vice versa. Think ahead of different scenarios that may happen, then you will be ready and know how to react and have predetermined entries or exits. Risk to reward ratio 1 to -3. Risk $1 to make 3. If SPY moves 1.5 points in your direction, take 1/3 profit. Take some risk off the table. If it goes another 1.5%, take another half off, and you can let the rest. Run risk-free, but set stop loss. Your last take profit limit. Sell. Stocks will either bounce, reject, or break out. Watch previous days low, high, and pre-market low and high. Hedge your position for protection. Watch and pay attention to price and volume if going up on low volume without momentum may be a rug pull incoming. Remember X3 or X4 if no catalyst and you get 4 to 5 pints move on SPY take. Profit before reverse or chop and theta decay premium burn, for example. Enter contract 3.25 and it hits your target now trading. 12.25 exit and take a profit important steps in trading. Trading method. Where and why you enter and exit. Risk management, risk per trade, and risk open position. Psychology discipline to execute method. Give equal importance to each step. If sell off a lot and it comes back up to test VWAP, as soon as it touches VWAP sell, especially if out of the money as soon as you see SPY starting to run. Towards VWAP, get your order ready to sell touch. Identify setups. Before trade and monitor while in trade, figure levels out so you already be ready to sell when they hit. Might only test one time with a 5-minute window before a reversal has to be quick, sometimes like a robot, Ike. The algos. My problem is when in profit I don't sell because need more money. But the real fact is I have to take what the market is offering the time before they take it all way and more. Make decisions based on careful thought, rather than the feeling at the time or being too eager or anxious, letting emotions get the best think before act 2. Avoid mistakes. Are variables in our favor? News catalyst. High, short interest. Elevated RVOL. Holding above VWAP. Consolidating above VWAP. Breaks out a bullish wedge pattern. High of day, news catalyst pattern, beaten down stock, trim your position target. If think will go more. Use small sizes to make big profits, X5 minus 10% of the account. Only start with 1 or 2 contracts. If the trade goes against you, you can manage the trade to get a bigger gain or make it a smaller loss. Remember to follow the rules. I lost everything and more because I was not patient and did not have the discipline to exit trades when I was supposed to, and I also had bad risk management by using too much entry size. Be patient and wait for proper setups. Focus on a plan, have great discipline, control emotions, have realistic expectations. Be patient, allow markets to come to you. Good analysis. Trade the chart, trade what you see and not what you think. Levels. Certain price levels are more important than others. A level can retain its importance for months or even years. At support levels, there is more demand than supply. At resistance levels, there is more supply than demand. Resistance levels can convert into support levels. Support levels can convert into resistance levels. Options. Delta is the of odds that trade will go in that direction. Implied vitality is how nervous fear before earning IV will rise and after will fall fours on not. Be concerned with how much you can lose. Relax and stay focused. Have a thinking mindset. Pay attention to indicators. Be in the performance of the moment. Don't hold ZDTE scalp for more than 5 to 15 minutes in the morning. Showing weakness of scalp is a scalp take profit and re-enter at a lower strike price. 52 to week high is bullish. When in doubt, zoom out and look. The SPY is the trend, strong or weak on the weekly chart. Look 3 days to left after hours pre-market for support or resistance. Have price alerts set. Watch until the setup presents itself. Patience is key. Do not show any faith or hopium in stocks unless they show strength. If volume is too high and overbought and the next day of momentum dies, amp. Stock has greater than lower vol will tend to fall. If stock goes up high for 2 days, most likely will fall on the 3rd day. Take profit and re-enter lower price. Know your risk management. Risk how much you are willing to lose. Only use 5% of cash value. Management on the performance of the trade. A call is bullish? No, the price at a put is bearish, which you enter. Skills are important and require paying attention, thinking, analyzing, problem solving. Remember, the seller of call or put is smart market makers are initially out to take your money. Choose premium. Wisely with insurance deep in the money. higher delta or longer time 2 to 3 weeks out for safer bet, less theta. Build an account up to sell, puts on a strong. Stocks, Tesla, Google, Apple. Watch out for fake news or early catalyst. Bullish strategy, secure passive income. Put credit spread covered calls. Ticker has to have high vol I. SPY, sell a put option and purchase another put option at a lower strike price. At the same expiration, less loss potential, less profit, but 80% gains. Safer IE stock. $40. Strike price, put price $81.37. 85 $2.84, buy put $95.09. Sell put $95, $8.05.9. Reeve 8.84 paid. Collected premium 2.25. Relieve credit max profit 2.25 100 plus per spread. If I sell the spread for 2.25 and it expires worthless, $0 trillion she gain per spread is 225. In this case, time theta will be on your side like the market MAKER 50. You will keep 100% of the premium. Max loss is spread. Net credit 100. X this spread width is. Short put strike, long put strike. Net credit. Break even, $90 to $2.25. Look at change close on options to see how much the option has. Increase due to premium. OTE. 0-day last day options expire worthless. Most. Only ride up its strong green candles on the 5 minutes. If it's choppy, get out of the stock is undecided. You can always re-enter when it makes its mind up in options. Time is not on your side. 50 have no time to be wasted. Move on to a winning trade. If stock is oversold for 2 weeks, tends to rally back up. Overbought at resistance will fall back down, especially if not a value. Stock, when adding into a position, always make sure it's a good confirmation. Be attentive and pay attention to chart. Have the courage to leap, but be prepared to ride the waves and swim. Know the news. Trade the chart. Choose your option strike price wisely. Pay attention to SPX premium prices in the close. Most of the time they are overcharging on 0-day expiration options even until the last 10 minutes, for example. If SPX is trading at 4,108 into close and they are still charging 350 for that 4,110 call, technically that call is already worthless. Or if it's trading 4,180 and it's trading 4,100 and they are charging 240 for 4,100 call, technically that call is only worth $80 at that time. Mental clarity is an edge. European close is 11:30, power hour 3. Always check volume. If volume is over its normal volume, is good trade. Lower volume tends to be bearish. Next day, lower LOL may fall. Look at 5 days for resistance and look at year for support. Use MMFI, indicator tier trading. Always start small. Be patient. Wait for the best setup. AMP, when it comes tiering. Levels to mark. Plot and know those levels. Pre-market high, pre-market low, previous day's high, previous day low, any intraday big support resistance on the 5 minute. If we are above pre-market high, it is a high probability we will head higher. If we are above the pre-market high and yesterday's high, the momentum and trend is clearly up. Now we can use this method for pre-market low and yesterday's lows. Intraday support and resistance levels can act the same as above. Markets can remain irrational longer than you can remain solvent. The trend is your friend until the end of that trend. Improve your trading. 1. Understand market mechanics. 2. Stick to one strategy. 3. Learn yourself. Personality, strengths and weaknesses. Emotions. 4. Become more disciplined. 5. Journal review all your trades. 6. Less screen time is more. Mental game. Need to have patience. Need to properly be able to read the market and the context clues it leaves us. 2. React to what the market presents us. Stop trying to predict. 3. Maintain proper risk management. Volatility means large price swings. Large price swings mean volatile emotions. We cannot let our emotions dictate our trading decisions. 4. More development, more information, more context, easier to read. Better trading decisions. If you cannot properly read what's going on, do not trade the action. Need to have a valid trading thesis before the trade is put on. 5. Do not enter the market blindly. Do not trade the market solely because it's moving up or down. Trade when you get your entry confirmation. Signals. 9. Patience is key. Sometimes no trade is the best trade. Knowing when to take a trade is key. Analyzing and waiting for a proper setup is best for the best overall outcome. The market is always moving. It will be here tomorrow. It will be here next week. It will be here next year. The problem with that is you might not be trading next week or next year if you don't focus on the process. If you don't, focus on coming up with a plan and only trading that plan when your edge is present. Do not regret a trade that you did not take that went to the moon or was a good trade. Remember, the market is always in motion and there will always be another trade. Allow the market to come to you. There is no point in chasing the market. Change your perspective. Set up your alerts throughout your session and learn to respect that window of trading. If no trading opportunities develop, then simply don't look for any trades. Markets usually fall fast and rise slowly. You must fall forward to get ahead. Trade in the money contracts or futures with time is safer to grow the account. Time in the market beats trying to time the market. Have realistic expectations as far as your learning journey or how long it will take you to reach consistency. Don't put a time on it. Simply focus on finding your edge and mastering the skill set, and the rest will follow. Surround yourself with successful mentors. Obviously, you can go the solo dolo route, but you will be saving so much of that time if you found the right guidance. Invest in some proper education. Your future self will thank you. You can make residual income in the markets by being consistent, following the rules, and only taking the best setup. Develop a business plan. Trading is a business and should be treated accordingly. Build a plan around your methodology, use confirmations, risk management, etc. In doing so, you will develop a professional environment for your craft and your trading business. Treating it in this manner will favor you in so many ways, and you will see massive improvement. Everyone takes losses. Even if you're a seasoned trader, you're bound to take losses. It's a natural part of trading, and it is inevitable. If you're managing your risk properly, trust me when I say you will start looking at your losses as small business expenses. Stay focused on mastering your trading rules and behavior to achieve your goals and become a better trader. Trading is the opposite of normal human instinct. Nature do not have any emotions tied to trade. Have patience. Wait until setup presents itself. 10. Self-awareness. Practice self-awareness. Wake up. Be aware when trading. Be attentive in the moment. Be aware of your own awareness and mindset. Be mindful to identify if you are about to do something stupid. Ask questions. Full analyze the full situation. Always remain disciplined, focused, and confident with zero fear. Take emotion out of trading and just follow the plan. Take profits quickly and cut losers even quicker. Pay attention to the VIX for market volatility, the US dollar, bonds, and Bitcoin as a gauge for direction. Be aware of your emotions, your state mind when you make a certain mistake. If you're doing it correctly, it will prevent you from repeating the same mistake. Observe your mistakes and be aware of your feelings. Take screenshots of bad trades and review them. You do learn a lot from bad trades, specifically from reviewing them. Have a journal with lots of screenshots of bad trades as a constant reminder. Screen time, practice, and education will make you capable of finding good trades, but learning to avoid the bad trades will make you profitable. Trust the process over profits. Become a high-achieving student to the markets every day, willing and ready to learn. Take notes on lessons, review, and record it into our conscious mind. State to become a better trader daily. If I overtrade and B2, I tune to trading every day, I may be hypnotized to take the wrong side of the trade market psychology. Remember, most news events are already priced in, and the markets are mostly forward-looking. In the past, most trades have gone against me in the opposite direction soon after entering, sometimes the logical. Fundamentally, best trade may be the wrong trade because most retail will be tricked into taking those positions only to lose all of their money. That's what market makers want to drain profits back out of. Retail mostly there for sometimes, but not all the time. The opposite trade of what your mind is telling you may be the best winning trade at that moment. When in doubt, zoom out to a higher time frame. Pay attention to key levels, price action, and volume, and if still unsure, hedge your position by playing it. Both ways, both call input, take profit on winner, next support, or resistance. Learn from losing trades. They have lessons to be remembered, but must not let emotions get involved. Must forget the emotion or trauma of past losing trades. The present and future have nothing to do with the past. The next trade may be the best trade you ever put on, but emotional stress will cause you to be fearful and not be able to take the winning trade. Must always be open-minded and have a clear, open-minded mindset. Become in the moment and be able to read and interpret what the markets are telling you at the moment. Each moment in the market is painting the picture and making history. We must observe as the puzzle comes together to give us an edge that will make sense to execute the winning trade we are destined for. Once you learn and instill these rules deep in your brain and be able to execute with confidence, you will then be able to extract as much money you want out of the markets over time. There is no limit to the amount you can make, but you must be disciplined enough to follow the rules and patient enough to wait for the proper setups and allow the follow through to happen. Allow the trades to come to you and take you to your next stop, exit, and wait for next entry. These strategies will most likely play out to be profitable over time. Compound interest adds up. As my mother always says, Rome was not built in one day. Be patient, and patience will pay yourself over time. Even 5% a day is 25% a week, which is over 100% of your money a month. Just imagine. We all know how easy it is to make 5 to 10% on an options contract. With the correct edge, could be within 5 to 20 minuets. Just 100% of your money a month over 12 months would be 1,200% a year. Small gains add up over time. That's not even including the big winners that may come along within the year. Key takeaway is to be patient, stay disciplined, and always follow your rules. And most importantly, protect your capital by cutting losing trades. Quickly, Psychology 101. Sometimes it's not about learning more about the markets, but more so about learning more about yourself and how you react to price action and trade. Get your head in the game. Meditate and work out every day. Eat healthy foods and get a good night's rest. Risk and success go hand in hand. Investing means volatility. Lose a battle, win the war. Focus on your long-term strategy. Create a positive risk-reward profile. Mistakes are growth opportunities. Remember from your mistakes, they are valuable lessons. Optimistic narratives are slow to grow and pessimistic fall quickly. We are responsible for becoming a constantly profitable trader. Top secrets of successful traders. Risk-taking should be calm, collected, and calculated. Define your process absent of emotion. You will not profit on every trade. Your portfolio will grow with rational risk-taking over time. Compound interest is powerful. It adds up. Most of the time, I'm one day ahead of my predictions. The market will do big moves when people least expect it. Why do I keep going against the trend? Before I enter trade, ask myself, where will my hedge position be? If we get a different reaction, we will see different results in the market. Trade in the now. Many traders are too focused on the past or the future, and they forget about the present. All that should matter is what the market is telling you right now. Context, entries, exits, volume, effort, reward, etc. You create your own. Stress, the market does not. How to trade in the now. React to price volume as it occurs in the present moment. being mindful of your feelings, thoughts, and how they affect your ability to make proper trading decisions. When most people are bearish, markets will tend to go up when least expected. Accept the risk of taking trades. No trade will have guaranteed profits. Learn to break bad habits. Control your environment. 90% of trading success is an emotional game, not an intelligence game. You have to teach yourself how to analyze the market, how to manage risk, how to cut losses if you want to be a profitable trader. Qualities of successful traders: passion, persistence, self-discipline, a desire to improve, a commitment to learning. In trading, mastering our thoughts takes consistency and patience. Have a trading schedule 2 to 4 day. You don't need to sit in front of the screen all day. There is enough money to be made trading only a few hours each day. Stop trying to squeeze every dollar out of the trading day when you have reached your profit target, or stop seeing setups. Stop trading. Fixing FOMO. Ask yourself one question before entering any trade. What is my risk to reward in this trade? If you cannot identify a good risk to reward, you should not take the trade. If you cannot determine a stop loss or profit target, you should not take the trade. Make the difference between a FOMO trade and a trade that maybe wasn't in your plan, but it's backed by your technicals. If you are concerned that price action is not clean, or that the volume is not enough, or that you don't have a confirmation, those concerns are not based on fear of entering. You see a good setup, you have confirmation, but you don't pull the trigger because of previous bad results. Disruptive fear. Your concern over another loss is based on a bad trading day. Your current trade idea has absolutely nothing to do with the outcome of a trade you took in the previous day. If you are reacting to your own concerns regarding profitability, you are acting in fear, and this will take you out of the current reality of the market. You will be acting based upon your own uncertainties and insecurities. Ask yourself, is it because of the price action, or is it because of your own insecurities? You'll need to be making your market decisions strictly on what the market is doing and showing you. This is the only way to be successful. If you are making your decisions on outside factors like how badly you need the money or what you need the money for, your judgment will be clouded and it will be much more difficult to see good opportunities to profit. Finding your zone. You deal with losses and failures every day. No setup is perfect and every setup is unique. Even winning days are full of small mistakes. Your new comfort zone. As a perfectionist, you're used to think inside the box rather than outside of it. But as a trader, feeling uncomfortable is your new comfort zone. Traders do not decide their success. They decide their habits, and their habits decide their success. Your bad trading habits might have been fun in the past, but now they just hold you back. They cost you money and make you emotional during trading. The longer you wait to fix your bad trading habits, the longer you will wait to be a profitable trader. As a trader, you will not win every trade. Traders spend more time waiting than trading. Traders are the most successful entrepreneurs out there. As traders, we are able to turn what excites us into profit. That is the core value of a successful entrepreneur. In the trading, you either adapt or the market will eat you alive. Don't be fooled by the pops or drops. Take profit on out-of-the-money contracts ASAP when the target hits fast from. Being down to in-profit contract premium will be elevated from the momentum in that direction, but as soon as it loses momentum, the premium will decay and lose value fast and drop if the momentum does not continue in that direction. Accept the loss on losing trades and close losing trades before the loss gets bigger. Have a tight stop loss on choppy days, scalp in and out. Important notes. Do not quit your job yet. If you've made it this far, you probably wouldn't do that anyway, but still, do not be discouraged. There will constantly be setbacks and new challenges. You should have an endless supply of motivation because even Though trading is incredibly difficult, there is nothing more rewarding. What does research say about the mental health of traders who lose money over time? Various studies conducted across the globe have explored the mental health of traders, revealing some common findings. Anxiety and depression are common among traders due to the high-pressure, fast-paced environment, market volatility, and potential for financial loss. Traders experiencing mental health conditions such as anxiety or depression are at a higher risk of making mistakes and incurring financial losses due to emotional decision-making, impulsive behavior, and a lack of focus, resulting in poor trading choices and increased risk exposure. Long-term stress in traders can negatively impact mental and physical health, leading to burnout, sleep issues, weakened immunity, and worsened mental health conditions. Social support and self-care are crucial for traders' mental health. A strong support network, exercise, mindfulness, and prioritizing self-care help manage stress and maintain trading performance. Early intervention is key to addressing traders' mental health concerns. Prompt professional help, like therapy or counseling, equips traders with coping strategies to sustain a healthy mental state. Essential mental health practices for traders. There are a number of things that traders can do to improve their mental health. These include build resilience. Resilience is the ability to bounce back from setbacks. Traders can build resilience by practicing gratitude, focusing on the positive, and adopting a growth mindset. Practice mindfulness. Mindfulness is the practice of paying attention to the present moment without judgment. Traders can practice mindfulness by meditating, doing yoga, or simply taking a few deep breaths. Maintain a healthy work-life balance. It is important for traders to have a life outside of trading. Make time for activities that you enjoy, such as spending time with family and friends, exercising, or pursuing hobbies. Adopt effective risk management strategies. Risk management is the process of minimizing losses. Traders can adopt effective risk management strategies by setting clear risk limits, diversifying their investments, and avoiding excessive exposure to volatile markets. 11. Trading technique strategy. The two ways to trade, discretionary versus systematic, both valid. Systematic traders create rules and only take trades when the market conditions meet a set of criteria, possible but difficult, because you are searching for a combination information that yields consistently profitable results in a market where price movements are the results of thousands of participants, all with different motives and position sizes. This is why most traders use a combination of rules discretion. Discretionary traders are not waiting for specific setups or rules to be met. The trades they take vary and can be different every day, are trading on intuition, a feeling which is developed through implicit memory and experience, can't be learned from a book, video, etc. Watching them trade will mostly just look like guessing because we have no idea what pattern or event happened to cause them to take a trade. Plot mark lines on previous days. Top and bottom of the body on day chart for next day support or resistance. Zones. In the morning, if the first 15 minutes only wicks to prior day, how's the stock is weak? If the body closed above or inside of the previous day low may continue. Pay attention to wick candles or full body candles for strength at support or resistance for reversal with volume. If in a wick candle exit trade, i.e. in strong body candle, watch for follow through. Sometimes support or resistance may be only tested once. Scalp 15 to 30 minutes tops and take profit levels. Avoid the chop theta decay fakeouts. Sell morning pop, buy back the drop. Most out of the money OT options will expire worthless. CES tick conditions entry stop target. Check MMFI stocks above 50-day moving average on bar chart. Have a disciplined plan for trade with no emotional attachment of past trades where you have a high, unusual pop sell quickly as everyone else will be selling. In this market, you only get paid from opportunity, not time, for proper setup opportunities to take advantage of a good risk to reward trade. Be a sniper. If a weak stock breaks below SMA and support Fibonacci level it may not go back up. Only play momentum stocks. Once stock loses momentum, it will go down, or it will consolidate until its next leg, up or down, puts a guaranteed a profit in a bear market. When a stock takes a big fall, most likely will fall for a few more days for institutions to get out. Most of the time will pop up due to shorts covering, but only for a dead cat bounce. No position is or will be perfect in the stock market. Good enough 1 second, good enough. Take the highest probability setups and take profit at targets as planned. Buy options when I've implied volatility is low. Sell options premium when IV is low. The market has to be liquid, or you may not be able to sell if no vol. Buyers. 1. Trade small positions. 2. With a high probability of success. 3. In liquid stocks and options. 4. Using the right strategy. 5. As many times as you can. Spy at low of day may come back to test VWAP and may fail in bear market. Sell 75% and hold one contract to come back to break even. Sell as soon as possible. If in a swing trade, take profit in the morning first 15 minutes after bell to 30 min. Then re-enter on pullback or sell most contracts then. Average down. If entering a new trade at new highs, wait for the direction of the chart. Key levels of support are resistance of the momentum for that day. Has to be trending with volume catalyst to take trade. Sell OT out of the money early on a Friday if they go green. On a bullish sentiment straight, gas cash open, wait for pullback to the pre-market low to go long and ride the trend up until wicking red candles at overbought RSI. Take profit into resistance. After quad witching options expirations, markets will go into a new cycle. Gamma long options markets profit liquidity. Gamma short take liquidity. Net long not volatile. Gamma volatile. VIX usually sells off after hitting 30 inverse 1. SPY will retrace back up if volley is greater than open interest. More contracts have been created and open. Look time and sales too. Find out if calls or puts opened or closed. Look option chain calls and puts open interest to see an expected move of market. More calls could react as a long gamma squeeze. Read the tape bid and ask, buyers and sellers supply a demand time and sales. Dissect the trades. Do not be stuck on one trade all day and miss better opportunities. Take profit targets. Hawkish, bearish, dove, bullish. When get a high volume bar on the day, big, red, or green bar on the day. Chart you can swing positions for 2 to 3 days. On momentum, gap up or gap down, get exposure to upside call low of day pre-market with high volume cash. Buy open watch for retest stop out. Below low of day or vice versa to downside put with high volume sell. Wicking high of day stop out above high of the day. Use 15-minute chart for more clarity intraday, especially on Webble 5. Minutes will not show levels until approached. Use stochastic RSI indicator for signs. Only look pre-market for the upside in a bull market, not a bearish market. Watch for big high volume red or green pin bars for reversal entry. On a big gap up or big gap down, if I am more bearish or bullish expecting the gap to fill it, may not. They don't always fill. Play both ways. 50% call and 50% puts. Take profit on winners. Sell other VWAP test. Directional bias. Directional bias is a way to stay on the winning side of the trade by not going against the sentiment. Look at the daily candle color. Red on the day or green on the day, and also above or below VWAP. More likely to long buy a green on the day above the VWAP setup and short sell a red on the day lower than the VWAP setup. Gap and go or gap and crap? Hack. At 10 minutes rigged, have buy to open limit orders set for both calls and puts closest to at the money for 25 cents to 50 cents, around $300 to $500 worth each for both. Or on the same day, SPY. QQQ have it set to buy contracts 10 cents. Or, even better, 5 cents. Use 1-minute chart for quick scalps in and out. With high conviction cryptocurrency like Bitcoin and Ethereum, it would be best to dollar cost average in them weekly and hold as a long-term investment. They are volatile in these markets whenever they hit a support area like Bitcoin. As of now, support is around 17,500 by more. And if they crash by even more, same as U.S. markets SPY, a yearly low of 362 by more, QQQ 268 by more over time, they will go back up. Only deploy funds that you will not need on a day-to-day basis for essentials, needs, and bills. Most assets, commodities, stocks, and securities are considered to be trading at a lower price right now as of Sept 2022, but they are mostly still overvalued, trading at a multiple higher than their actual earnings. Since the COVID pandemic, the Fed had to pump money into the economy, QE, in order to save the economy, but they printed too much liquidity, which had caused all of the markets, including stocks, cryptocurrencies, commodities, and the housing market, to become overvalued. And in a bubble, this also caused inflation to rise. They have retraced a bit since the highs. Many economists are bearish, saying they will go lower, and many are bullish, stating they will go higher sooner, but no one really knows. All we can do is trade the chart and react to the trending price action at the time. Reread and study these rules. Remember these rules. Follow the rules if have to read every morning. Do so. These are notes from overtime of my experience trading. Not every strategy will work every time. Every day will be different, but they do have the advantage to give your trading an edge. Must determine when the appropriate time is to apply them and profit. It has to make sense. I hope this book will help save many traders money and can be of assistance in gaining profits, so everyone will be able to achieve their dreams and goals, and finally be able to build generational wealth and cop their win Lambos, yachts, mansions, and penthouses. Always remain motivated, humble, dedicated to becoming the best trader you are destined to be. Let's get it and make it happen. Think positive affirmations into existence. 12. Law of propensity. Don't focus on the money. Focus on what do I need to learn and how can I adjust my mind to trade the markets properly. Marginal propensity to save MPs is an economic measure of how savings change given a change in income. It is calculated by simply dividing the change in savings by the change in income. A larger MPS indicates that small changes in income lead to large changes in savings. STRATEGY. Risk management. Bring the mind to the moment of trading. Trading psychology. Be patient. There will always be another trade. Your mind is a magnet. You are your thoughts. Think positive thoughts. Good things tend to happen. Think negative things. Bad things tend to happen. Best to always cultivate good, positive thoughts with a clear thinking mindset. Important traits of a good trader. Passion for the financial markets and trading. Established capability for systematic problem-solving. Technical skills. Acute understanding of risk-taking in uncertain conditions. Programming languages, algorithm theory, and statistics. Strategic decision-making skills. Strong ability to take in new information and act quickly. Resilience. The desire to take ownership, commitment to working with integrity, and ability to overcome obstacles to achieve long-term goals. Intellectual curiosity and a motivation to learn. Identify pricing inefficiencies and collaborate with traders to monetize predictions. Identify new sources of data and transform unstructured data sets into signals. Own the information space you work within, that is large cap tech. By monitoring trends in the marketplace, employ a holistic approach to predicting the distribution of outcomes and making volatility predictions. Ability to think about the world systematically and quantitatively, as well as the ability to deal with uncertainty in a logical and consistent approach. How to attract. 1. Calm our nervous system. 2. Ask your soul what it truly wants. 3. Focus on your intention. Be specific. 4. Imagine the feeling of it happening. 5. Let go of expectations. 6. Dwell in gratitude. What do you desire? Have certainty and clear intention about your desire. Clarity is key. Breathe in and affirm, I accept and I am worthy of all I desire. Imagine how attaining that. Desire will bring happiness to you and those you love until you find excitement and positive emotion. Once found, inhale deeply and lock the feeling into every part of our body. Only take action on things that relate to and excite positive emotion to your desire. You must learn to follow your plan by trading the chart and executing when your signals trigger without hesitation. It's an exercise. That is the only result you should be looking for. It doesn't matter if the trade was good or bad. Flawless execution does not mean you bought at the lowest price and sold at the highest. 99% of the time, you will never buy the bottom and sell the top. You don't need to do that to make good money. Trading flawless execution, to me, means you perceive opportunity and you act upon it without thinking. Flawless execution, trade the chart, follow the plan. Terrible execution, emotions do the trading. Trying to extract money from the markets fast is usually a setup for failure and is the wrong approach. But with time and patience, smaller gains in the market tend to be a key for success. Discipline refers to rule-following behavior, to regulation, order, control, and authority. It may also refer to punishment. Discipline is used to create habits, routines, and automatic mechanisms such as blind obedience. It may be inflicted on others or on oneself. Self-discipline refers to the practice of self-restraint, controlling one's emotions and ignoring impulses. What is the law of supply and demand? The law of supply and demand combines two fundamental economic principles describing how changes in the price of a resource, commodity, or product affect its supply and demand. As the price increases, supply rises while demand declines. Conversely, as the price drops, supply constricts while demand grows. Levels of supply and demand for varying prices can be plotted on a graph as curves. The intersection of these curves marks the equilibrium or market clearing price at which demand equals supply and represents the process of price discovery in the marketplace. Trading skills. Components of consistency. Develop the ability to recognize if you have crossed the threshold from normal self-confidence into a state of euphoria. Learning to trade without fear, hesitation, or internal conflict is a function of believing that you don't have to know what is going to happen next on a trade-by-trade basis to win or make consistent money. How to think like a professional. Thinking, assuming, or believing you know what will happen next creates an unrealistic expectation in a specific outcome. Typical trading errors that the professional has evolved beyond. Don't define the risk in advance of putting on a trade. Define the risk, but don't take the loss, and it turns into a bigger loss. What characteristics distinguish the pro from the typical trader? Professionals plan their trades. They execute their plan without error. They can move in and out of their trades with an ease and effortlessness that would boggle the mind of the typical trader. What characteristics distinguish the pro from the typical trader? Professionals plan their trades. They execute their plan without error. They can move in and out of their trades with an ease and effortlessness that would boggle the mind of the typical trader. Components of consistency. Have a trading plan on how to utilize the edge risk parameters, money management, position size, profit objectives. Unrealistic expectations cause us to define and interpret and therefore perceive market information as threatening. Being wrong, losing, missing out, leaving money on the table. Typical trading errors that the professional has evolved beyond. Don't define the risk in advance of putting on a trade. Define the risk, but don't take the loss, and it turns into a bigger loss. Let a winning trade turn into a loser without having taken any profits. Move a stop closer to an entry point, get stopped out, and the market trades back in your favor. Why futures are the good to trade? No PDT rule, options, and stocks require $25. 0,000 to do more than 3-day trades in a 5-day period. Trade with just a couple $100. Superior trading platform. 60/40 tax rule. Massive. Choose your exposure. M&Q. is $2 per point, or you could trade 10 plus contracts on NQ at $200 per point. High liquidity, easily get in and out of positions. Very small spreads, flexible hours. Trading almost 24/6, trades settle instantly. How Treasury bond auctions affect the stock market. Treasury bond auctions can affect the stock market by influencing interest rates, yield curve dynamics, and investor sentiment. For example, bond auctions can move yields, which can in turn move stocks. For example, the sale of $37 billion in 10-year notes has repercussions for rates on mortgages and credit cards. Some auctions have tailed, meaning they've required higher yields to entice buyers. In these cases, the market follows, selling us treasuries. The impact in the stock market can be more considerable, depending on how much yields rise in such cases. In the 15-minute interval following an auction, futures prices move higher, volatility increases, and there is an upturn in trading volume. Primary dealers who purchase the largest proportion of each issue have the greatest influence on the market response. 13. Definitions. Option types. Call the right, not the obligation, to buy a stock at a specific price. The call. Buyer owns the right, whereas the call seller has the obligation. Put. The right, not the obligation, to sell stock at a specific price. The put. Buyer owns the right, whereas the put seller has the obligation. Options contracts. Notional contract size represents the amount of the underlying asset controlled by one options contract. For example, one standard listed options contract controls 100 shares of stock. Contract multiply represents the number of underlying assets, shares, controlled by an options contract. For standard equity options, one contract controls 100 shares of the underlying. The contract multiplier in this case is 100%. Underlying assets. Stock, a security that represents partial ownership, measured in shares, of a company. Options contracts on single-name stocks derive their value from the price of the underlying shares. Index. An indicator or measurement tool that tracks the performance of a group of assets or a basket of securities. Options on an index are typically cash settled because the index itself is not directly tradable. Expiration. Expiry. Expiration. The specified date and time when the options contract ends or expires. Leaps. Long-term equity anticipation. Securities. Leaps options have the same characteristics as those of standard listed options, but with expiration dates up to 3 years in the future. Moneyness. Strike price. The price paid or received for the underlying asset if the options contract is exercised. At the money describes an options contract that has a strike price equal to the market price of the underlying asset. The money. Calls. A call option is described as in the money or ITM if the market price of the underlying asset is above the strike price. Puts. A put option is described as in the money or ITM if the market price of the underlying asset is below the strike price. Out of the money. Calls. A call option is described as out of the money or OTM if the market price of the underlying asset is below the strike price. Puts. A put option is described as out of the money or OTM if the market price of the underlying asset is above the strike price. Premium. Premium price, the amount paid or received for the options contract. Intrinsic value. This represents the current value portion of an option, which is the difference between the current price of the underlying and the strike price of the option. The intrinsic value is the amount an option is in the money. For example, stock XYZ is trading at $200. The 195 calls can be described as in the money and have $5 of intrinsic value. Time value represents the portion of the option's premium based on the amount of time remaining until its expiration date. Time value is often estimated as the difference between the option's premium and its intrinsic value. Option Greeks. Greeks measures that determine the sensitivity of the option's price to changes in certain variables, like the price of the underlying asset, the rate of change in the price of the underlying asset, time decay, implied volatility, and interest rates. Delta measures the change in the option price given a $1 change in the price of the underlying asset. Gamma measures the change in delta for a $1 change in the price of the underlying asset. Theta measures the change in the option price as time to expiration decreases, also known as time decay. Since both puts and calls are susceptible to time decay, theta is always expressed as a negative number. Vega measures the change in the option price for. Implied volatility is the market's forecast of a likely movement in price. It is a metric used by investors to estimate future fluctuations, volatility, of a security's price based on certain predictive factors. Implied volatility is denoted by the symbol bullish, also known as dovish. Also known as a bull, believes that the price of one or more securities or indexes will rise. This can apply at any scale of the market. Sometimes a bullish investor believes that the market as a whole is due to go up, foreseeing general gains. Bearish, also known as hawkish. Being bearish in trading means you believe that a market, asset, or financial instrument is going to experience a downward trajectory. Being bearish is the opposite of being bullish. Sentiment, attitude, thought, or judgment prompted by feeling. Predilection, a specific view or notion. Opinion, emotion, refined feeling. Short squeeze. A short squeeze is an unusual condition that triggers rapidly rising prices in a stock or other tradable security. For a short squeeze to occur, the security must have an unusual degree of short sellers holding positions in it. The short squeeze begins when the price jumps higher unexpectedly. The condition plays out as a significant measure of the short sellers coincidentally deciding to cut losses and exit their positions. Pump and dump, a form of securities fraud that involves artificially inflating the price of an owned stock through false and misleading positive statements. In order to sell the cheaply purchased stock at a higher price, rug pull, FUD, fear, uncertainty, and doubt, usually evoked intentionally in order to put a competitor at a disadvantage. FOMO. The fear of missing out. FOMO is an emotional response to the belief that other people are living better, more satisfying lives, or that important opportunity are being missed. FOMO often leads to feelings of unease, dissatisfaction, depression, and stress. Buy. This means buying shares or taking a position in a company. Sell. Getting rid of the shares as you have achieved your goal or want to cut down losses. Ask. Ask is what people who are looking to sell their stocks are looking to get for their shares. Bid. Bid is what you are willing to pay for a stock. Ask, bid, spread. Spread is the difference between what people want to spend and what people want to get. Bull. A bull market is a market condition where investors are expecting prices to rise. Bear. A bear market is a market condition where investors are expecting prices to fall. Limit order. A limit order is a type of order which executes at the price placed for buy or sell. Market order. A market order is a type of order which executes as quickly as possible at the market price. Day order. A day order is a direction to a broker to execute a trade at a specific price that expires at the end of the trading day if it is not complicated. Volatility. This means how fast a stock moves up or down. Going long, betting on the stock price will increase so that you can buy low and sell high. Averaging down. This is when an investor buys as the stock goes down, so as to increase the price at which purchased. Capitalization. This is what the market thinks a company's value is. Float. This is the number of shares that can be actually traded after deducting the shares held by insiders. Authorized shares. This is the total number of shares that a company can trade. IP. It is an initial public offering that happens when the private company becomes a publicly traded company. Secondary offering. This is another offering in order to sell more stocks and to raise more money from the public. Dividend. A portion of the company's earnings that is paid to the shareholders. Broker. A broker is a person who buys or sells stocks on your behalf. Exchange. An exchange is a place where different types of investments are traded. Portfolio. A collection of investments owned by you. Margin. A margin account lets a person borrow money from the broker to buy shares. Sector. A group of stocks in the same sector. Stock ticker symbol. A 1 to 3 character alphabet root symbol which represents a company listed on the exchange. Stock split. A stock split happens when a company increases the number of its shares to boost the stock's liquidity. Although the number of shares outstanding increases by a specific multiple, the total dollar value of all shares outstanding remains the same because a split does not fundamentally change the company's value. The most common split ratios are 2:1 or 3:1, sometimes denoted as 2 or 3:1. This means for every share held before the split, each stockholder will have 2 or 3 shares respectively after the split. Types of technical indicators. There are 4 main types of technical indicators: trend following, oscillators, volatility, and support resistance. They are grouped based on their function, which ranges from revealing the average price of a currency pair over time to providing a clearer picture of support and resistance levels. List of technical indicators. Trend indicators. Trend following indicators were created to help traders trade currency pairs that are trending up or trending down. We have all heard the phrase, "The trend is your friend." These indicators can help point out the direction of the trend and can tell us if a trend actually is valid to exist. Moving average MA. The MA, or simple moving average SMA, is an indicator used to identify the direction of a current price trend without the interference of shorter-term price spikes. The MA indicator combines the price points of a financial instrument over a specified time frame and divides it by the number of data points to present a single trend line. The data used depends on the length of the MA. For example, a 200-day MA requires 200 days of data. By using the MA indicator, you can study levels of support and resistance and see previous price action, the history of the market. This means you can also determine possible future patterns. Technical tool that averages a currency pair's price over a period of time. The smoothing effect this has on the chart helps give a clearer indication on what direction the pair is moving, either up, down, or sideways. There are a variety of moving averages to choose from, with simple moving averages and exponential moving averages being the most popular. Exponential moving average, E. E is another form of moving average. Unlike the SMA, it places a greater weight on recent data points, making data more responsive to new information. When used with other indicators, EMAs can help traders confirm significant market moves and gauge their legitimacy. The most popular exponential moving averages are 12 and 26-day EMAs for short-term averages, whereas the 50 and 200-day EMAs are used as long-term trend indicators. Stochastic oscillator. A stochastic oscillator is an indicator that compares a specific closing price of an asset to a range of its prices over time, showing momentum and trend strength. It uses a scale of 0 to 100. A reading below 20 generally represents an oversold market, and a reading above 80% an overbought market. However, if a strong trend is present, a correction or rally will not necessarily ensue. Moving average convergence divergence, MACD. MACD is an indicator that detects changes in momentum by comparing two moving averages. It can help traders identify possible buy and sell opportunities around support and resistance levels. Convergence means that two moving averages are coming together, while divergence means that they're moving away from each other. If moving averages are converging, it means momentum is decreasing, whereas if the moving averages are diverging, momentum is increasing. The moving average divergence tracks the difference between two EMA lines, the 12 EMA and 26 EMA. The difference between the two as is then drawn on a subchart called the MACD line, with a 9 EMA drawn directly on top of it, called the signal line. Traders then look to buy when the MACD line crosses above the signal line, and look to sell when the MACD line crosses below the signal line, as seen here. There are also opportunities to trade divergence between the MACD and price. A Bollinger Band is an indicator that provides a range within which the price of an asset typically trades. The width of the band increases and decreases to reflect recent volatility. The closer the bands are to each other, or the narrower they are, the lower the perceived volatility of the financial instrument. The wider the bands, the higher the perceived volatility. Bollinger Bands are useful for recognizing when an asset is trading outside of its usual levels, and are used mostly as a method to predict long-term price movements. When a price continually moves outside the upper parameters of the band, it could be overbought, and when it moves below the lower band, it could be oversold. Relative Strength Index, RSI. RSI is mostly used to help traders identify momentum, market conditions, and warning signals for dangerous price movements. RSI is expressed as a figure between 0 and 100. An asset around the 70 levels is often considered overbought, while an asset at or near 30 is often considered oversold. An overbought signal suggests that short-term gains may be reaching a point of maturity and assets may be in for a price correction. In contrast, an oversold signal could mean that short-term declines are reaching maturity and assets may be in for a rally. The Relative Strength Index is arguably the most popular oscillator to use. A big component of its formula is the ratio between the average gain and average loss over the last 14 periods. The RSI is bound between 0 and 100 and is considered overbought above 70 and oversold when below 30. Traders generally look to sell when 70 is crossed from above and look to buy when 30 is crossed from below. Fibonacci retracement. Fibonacci retracement is an indicator that can pinpoint the degree to which a market will move against its current trend. A retracement is when the market experiences a temporary dip. It is also known as a pullback. Traders who think the market is about to make a move often use Fibonacci retracement to confirm this. This is because it helps to identify possible levels of support and resistance, which could indicate an upward or downward trend. Because traders can identify levels of support and resistance with this indicator, it can help them decide where to apply stops and limits or when to open and close their positions. Ichimoku Cloud. The Ichimoku Cloud, like many other technical indicators, identifies support and resistance levels. However, it also estimates price momentum and provides traders with signals to help them with their decision-making. The translation of Ichimoku is one-look equilibrium chart, which is exactly why this indicator is used by traders who need a lot of information from one chart. In a nutshell, it identifies market trends, shows current support and resistance levels, and also forecasts future levels. Standard deviation. Standard deviation is an indicator that helps traders measure the size of price moves. Consequently, they can identify how likely volatility is to affect the price in the future. It cannot predict whether the price will go up or down, only that it will be affected by volatility. Standard deviation compares current price movements to historical price movements. Many traders believe that big price moves follow small price moves, and small price moves follow big price moves. Average Directional Index, ADX. The ADX illustrates the strength of a price trend. It works on a scale of 0 to 100, where a reading of more than 25 is considered a strong trend, and a number below 25 is considered a drift. Traders can use this information to gather whether an upward or downward trend is likely to continue. ADX is normally based on a moving average of the price range over 14 days, depending on the frequency that traders prefer. Note that ADX never shows how a price trend might develop. It simply indicates the strength of the trend. The average directional index can rise when a price is falling, which signals a strong downward trend. ADX indicator. The average direction index won't tell you whether price is trending up or down, but it will tell you if price is trending or is ranging. This makes it the perfect filter for either a range or trend strategy by making sure you are trading based on current market conditions. Oscillator indicators. Oscillators give traders an idea of how momentum is developing on a specific currency pair. When the price tracks higher, oscillators will move higher. When the price drops lower, oscillators will move lower. Whenever oscillators reach an extreme level, it might be time to look for a price to turn back around to the mean. However, just because an oscillator reaches overbought or oversold levels doesn't mean we should try to call a top or a bottom. Oscillators can stay at extreme levels for a long time, so we need to wait for a valid sign before trading. Stochastics indicator. Stochastics offer traders a different approach to calculating price oscillations by tracking how far the current price is from the lowest low of the last X number of periods. This distance is then divided by the difference between the high and low prices during the same number of periods. The line created K is then used to create a moving average D that is placed directly on top of the KCCI indicator. The commodity channel index is different from many oscillators in that there is no limit to how high or how low it can go. It uses 0 as a center line with overbought and oversold levels starting at 100 and minus 100. Traders look to sell breaks below 100 and buy breaks above 100. Volatility indicator. Volatility measures how large the upswings and downswings are for a particular currency pair. When a currency's price fluctuates wildly up and down, it is said to have high volatility, whereas a currency pair that does not fluctuate as much is said to have low volatility. It's important to note how volatile a currency pair is before opening a trade, so we can take that into consideration with picking our trade size and stop and limit levels. Bollinger Bands indicator. Bollinger Bands print 3 lines directly on top of the price chart. The middle band is a 20-period simple moving average with an upper and low band that is drawn 2 standard deviations above and below the 20 mega amperes. This means the more volatile the pair is, the wider the outer bands will become, giving the Bollinger Bands the ability to be used universally across currency pairs no matter how they behave. ATR indicator. The average true range tells us the average distance between the high and low prices over the last set number of bars, typically 14. This indicator is presented in pips where the higher the ATR gets, the more volatile the pair is, and vice versa. This makes it a perfect tool to measure volatility. Support resistance indicators. Support and resistance are key to technical analysis. The concept refers to the price levels on charts that form barriers to an asset price being pushed in a given direction. Pivot points. Pivot points are one of the most widely used in all markets, including equities, commodities, and Forex. They are created using a formula composed of high, low, and close prices for the previous period. Traders use these lines as potential support and resistance levels that the price might have a difficult time breaking through. Donchian channels. Price channels or Donchian channels are lines above and below recent price action that show the high and low prices over an extended period of time. These lines can then act as support or resistance if the price comes into contact with them again. For a deeper look at using this tool successfully, what you need to know before using trading indicators. The first rule of using trading indicators is that you should never use an indicator in isolation or use too many indicators at once. Focus on a few that you think are best suited to what you're trying to achieve. You should also use technical indicators alongside your own assessment of the movements of an asset's price over time, the price action. It's important to remember that you have to confirm a signal in some way. If you're getting a buy signal from an indicator and a sell signal from the price action, you need to use different indicators or different time frames until your signals are confirmed. Another thing to keep in mind is that you must never lose sight of your trading plan. Your rules for trading should always be implemented when using indicators, technical indicators. A summary. Each of the technical indicators above can help you to advance your technical analysis and better understand price action. But it's important to remember not to get bogged down and to choose only the indicators that work for you. Overly complicating your approach with too many indicators can force traders to process too much information, resulting in paralysis by analysis. As a result, it's best to keep it simple and only use a handful in accordance with the goal set out in your trading plan. Inflation. Inflation is a rise in prices, which can be translated as the decline of purchasing power over time. The rate at which purchasing power drops can be reflected in the average price increase of a basket of selected goods and services over some period of time. The rise in prices, which is often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. Inflation can be contrasted with deflation, which occurs when prices decline and purchasing power increases. What is stagflation? Stagflation is an economic cycle characterized by slow growth and a high unemployment rate accompanied by inflation. Economic policymakers find this combination particularly difficult to handle, as attempting to correct one of the factors can exacerbate another. Consumer Price Index, CPI. The Consumer Price Index, CPI, measures the monthly change in prices paid by U.S. consumers. Producer Price Index, PPI, measures the average change over time in the prices domestic producers receive for their output. It is a measure of inflation at the wholesale level that is compiled from thousands of indexes measuring producer prices by industry and product category. What is personal consumption expenditures? PC. Personal consumption expenditures, PC, also known as consumer spending, is a measure of the spending on goods and services by people of the United States. FOMC meeting refers to the 12 members of the FOMC who meet 8 times a year to discuss monetary policy. During the FOMC meeting, members discuss developments in the local and global financial markets, as well as economic and financial forecasts. What are the FOMC minutes? The FOMC meeting minutes provide a detailed summary of the FOMC discussion and inform the public and Congress about the full range of policymakers' views and debates about monetary policy issues, including the diversity of views. What is the Beige Book? The Beige Book is a report produced and published by the Federal Reserve. The report, referred to formally as the Summary of Commentary on Current Economic Conditions, is a qualitative review of economic conditions. The Beige Book is published 8 times each year before meetings held by the Federal Open Market Committee, FOMC, and is considered one of the most valuable tools at the committee's disposal for making key decisions about the economy. Quantitative easing, QE, is a monetary policy whereby the central bank purchases predetermined amounts of government bonds or other financial assets, e.g. municipal bonds, corporate bonds, stocks, etc., in order to inject money into the economy to expand economic activity. Quantitative easing is an unconventional form of monetary policy. What is quantitative tightening? QT. Quantitative tightening, QT, refers to monetary policies that contract or reduce the Federal Reserve System, Fed balance sheet. This process is also known as balance sheet normalization. In other words, the Fed, or any central bank, shrinks its monetary reserves by either selling treasuries, government bonds, or letting them mature and removing them from its cash balances. This removes liquidity or money from financial markets. It is the opposite of quantitative easing. a term that has become ingrained in the financial markets vernacular since the 2008 financial crisis, which refers to monetary policies adopted by the Fed that expand its balance sheet. What are jobless claims? Jobless claims are a statistic reported weekly by the U.S. Department of Labor that counts people filing to receive unemployment insurance benefits. There are two categories of jobless claims: initial, which comprises people filing for the first time, and continuing, which consists of unemployed people who have already been receiving unemployment benefits. Jobless claims are an important leading indicator of the state of the employment situation and the health of the economy. Jerome Powell is the head member of the Fed when he speaks to market. Moves and react. Mark your calendars and be aware of these economic reports. Company earnings and news to come out all can and will move markets. Conclusion: reread and study these rules. Remember these rules. Follow the rules if have to read every morning. Do so. These are notes from overtime of my experience trading. Not every strategy will work every time. Every day will be different, but they do have the advantage of giving your trading an edge. Must determine when the appropriate time is to apply them and profit. It has to make sense. I hope this book will help save many traders money and can be of assistance in gaining profits so everyone will be able to achieve their dreams and goals and finally be able to build generational wealth. And cop there when Lambos, yachts, mansions, and penthouses always remain motivated, humble, and dedicated to becoming the best trader you are destined to be. Let's get it and make it happen. Think positive affirmations into existence. As my long-lost friend used to say, it's time. Or Trent White, also known as Bankroll Fresh. IG. Trade Cash Twitter, One Fly Hustle. Trade Volatility. Day. Trading. Techniques. -1.400.70. Anthony Jones.